Okay, good morning, ladies and gentlemen. I want to confirm that we can hear me loud and clear. Good morning, good afternoon, good evening, depending on which part of the world you have joined us from. And it gives me great pleasure to welcome everyone to this year's Nigeria Investor Day. I think I want to quickly recognize different groups that are here this morning. It gives me great delight to welcome our investing clients, both local and foreign, network managers, regulators, and FMIs. I think special mention the DG of SEC, Securities and Exchange Commission, here ably represented by the Executive Commissioner Operations, Mr. Dayo Bison. We're very honored to have you. I also like to welcome the DG DMO, Mrs. Saratu Umar, the Executive Secretary, NIPC, DG DMO, Ms. Pat Fournier. Good to have you. Welcome the CEO, FMDQ Holding PLC, Mr. Bola Onodele Koko. Good to have you. Mr. Jude Chiamaka, Divisional Head Capital Markets at the NGX. You're most welcome. Mr. Jalo Arunawasiri, I want to welcome your CEO, CSCS PLC. I want to welcome all my distinguished colleagues, fund managers, bankers, PFAs, government agencies, and even prospective investors who are here with us this morning. Welcome, ladies and gentlemen. We operate in a very challenging environment. And I don't think some of us in our adult lives, I don't think we have been in a challenging environment, more challenging than this. At a time where inflation rates across the globe is at record highs, almost hitting double digits in developed countries. I think in Ghana, just a few days ago, we had inflation is over 40%. Nigeria having a fair share of inflation, 24.5%. And the same FX liquidity issue, which is not peculiar to Nigeria. We can say that we are presently in a situation where every one of us involved in the investment management ecosystem, need to actually rethink how we do our businesses and how we can continue to preserve value and give yields and return to our investors. The purpose of today, and maybe if you permit me just to say a few things about the organizers of today's event, the Association of Asset Custodians of Nigeria, which is a body of banks and financial institutions that offer safekeeping, settlement, and clearing, of securities of different types. It's an association, as of today, it's an 8-institutional association, but I believe that there are more members that are joining. The AACN, as part of its mandate, started 2009, and today we are hosting the 10th edition of the annual Nigeria Investor Day conference, right? This is typically a conference that we host in London, Canary Wharf, I think the first 8 editions. And because of the lockdown that we had 2 years ago, we've been hosting this conference virtually. This is the second edition that we are hosting virtually, but we are very hopeful that come next year by May, we will return to London, which is a global commercial center, and where we can have foreign and local investors gather to discuss issues that are focused on Nigerian capital market. So we are gathered here this morning and to early part of the afternoon, to discuss topical issues that affect the Nigerian capital market, and not just to discuss, but to come up with, market advocacy ideas, thought leadership initiatives. And this is one thing where we have achieved year in, year out through this conference. I mean, we're always very proud to to give example of the electronic certificate of capital importation project, which was something that came up in one of the early editions of this conference. We've also had other things like ISIN, depository automations and co. So we're hoping that today we would go away with thought-provoking ideas, aimed at further developing our market and making our markets more attractive. Our topic or the theme of today is capital flows, investment and regulatory landscape. And I'm very excited looking at the list of speakers that we've got here. I think we are in for a very engaging day. As I close, I would like to relay the apology of His Excellency, the Vice President of the Federal Republic of Nigeria, Professor Yemi Osinbajo, SAN, GCON in absentia. He had confirmed his attendance, but we were told that because the president is presently out of town and he had to take up some presidential responsibilities, it was on that note that he had to send his apologies, but he has confirmed to us that he's with us and is wishing us a fantastic day. I close with a quote from Henry Kaiser. Henry Kaiser said, "Problems are only opportunities in work clothes." And it's my firm belief that at a time where things are very low, is a time where we as market participants, operators, investors really need to sit down and say, despite all our challenges, what are the silver linings in the sky? What are the opportunities that we should be looking at? We also believe in AACN that the time where activities are low, investor appetites are low, is actually the time to also look at your market infrastructure and see what can you fix, in preparation for the turn of the cycle. We know it's always a cycle. Something is going to happen at some point, and we're also going to begin to see increased investment appetite. So I want to welcome us to what promises to be thought-provoking, interactive, and hoping that this day will birth new ideas and new initiatives that maybe in the next few months or years, we can look back and say, when we met at AACN Conference 2022, we were able to come up with this, and our market is better for that. So without further ado, I would like to hand over back to one of the moderators of today to take us to the next item on the agenda. I say a warm welcome to everyone. Let's have a great discourse. Thank you.
Thank you very much, Mr. President Abiodun Adebimpe. Key items you mentioned in your conversation touched on why we need to change the narrative. Tough times don't last, but tough people do. And in the capital market in Nigeria, we pride ourselves to say over the years, we have turned the narrative around. Today happens to be a packed full day, given the subject, Nigeria capital flows, investment, and regulatory landscape. And like the president of AACN has said in his opening remarks, we have an array of speakers from the regulatory side to financial market infrastructure, to policymakers, to economists, and the list goes on. It's my joy and my pride today to welcome our first speaker, who is the DG of the Securities and Exchange Commission, the apex regulator for the capital market in Nigeria, Dr. Lamido Yuguda, CFA, who is ably represented by the Honorable Commissioner of Operations, Mr. Dayo Obison. And the focus of his discourse and conversation will be around the regulatory nexus, developing the market or regulatory needs. And we'd like him to give us a view as to what the plan of the SEC is from that perspective. Joining him from a coordinating perspective will be Mrs. Folusho Ogundele, who is the MD of Zenith Nominees. Mr. DG, Mr. Dio Bisa, the floor is yours.
Okay, thank you very much. And thank you very much. I think firstly, before I start anything, I'd like to express the DG's warm and well wishes. He himself, he had been scheduled to be here and actually wanted to be here, but last minute had to be drawn out to respond to our employers, that's at the National Assembly, to give account. I mean, it is expected at this time of the year, budgets, accountability, let us know what you've done. So he had to run up, but he sends his warm regards, and he has actually dispatched me to deliver his paper and take on any further clarification that might be required at this forum. So without much ado, I'll just go ahead to read his paper. First, by protocol, and I'm not sure anyone has been fully established, but I'd like to acknowledge the DG of the DMO. I think we're still expecting a DG of PENCOM, some CEOs here present, FMDQ, and others. And I'd like to really thank the organizers for inviting the SEC. So I begin by reading the DG's remarks for his paper. Let me start by congratulating the Association of Asset Custodians of Nigeria for organizing this year's conference and for the broad and interesting topic, the regulatory nexus, developing the market or regulating it. I am delighted to have been invited as a special guest and a speaker on this topic, which focuses on capital market players, capital flows, financial market infrastructure, investment and regulatory changes, and the impact of politics on the development of our markets. Specifically, my paper will provide insights into some important capital market related issues, which I believe are of interest to this gathering, as well as other stakeholders. Firstly, licensed central counterparties with emphasis on reasons and expectations for the market. 2, insolvency and asset recovery. 3, new guidelines for raising capital through digital assets and roles of custodians and other digital capital market players, with highlights on the Commission's position on cryptocurrency and digital assets, among others. Let me start by addressing the seeming dichotomy between market development and market regulation, and which of them should rank higher. The Commission's dual mandates of market development and market regulation are intertwined to the extent that regulation is considered a precondition for orderly market development. A viable and well-functioning capital market requires sound market infrastructure with all-encompassing legal and regulatory frameworks. Notwithstanding the importance of regulation, its practical application must not be excessive in ensuring compliance with laid down rules and regulations for market players to thrive while safeguarding ethical practices in the market. History has indeed shown that inadequate or absence of regulation is detrimental to the capital markets, and I'm sure you will all agree, as it encourages sharp practices by participants at all levels. Regulatory agencies are therefore necessary to police activities in the market with the ultimate aim of minimizing abuses, which negatively impacts investor confidence. Because of the broad roles the Commission play in this delicate balancing of regulating and developing the market, I will highlight the Commission's perspective on 3 important topical issues. I will conclude by situating these within the wider paradigm of creating an enabling business environment in Nigeria to enhance trade, investment, and economic development. Firstly, I'll speak on the SEC and national development. In its resolve to implement impactful projects and programs towards national development, the Commission developed a comprehensive 10-year capital market master plan in 2015. Encouraged by the successes achieved and the need to incorporate internal and global development into this important roadmap, the Commission had to review the master plan in 2022, taking into consideration the leading roles several developments such as technology and non-interest finance have now come to play in our markets. The cardinal objective of the document is to expand the depth and breadth of the Nigerian capital market to enable it contributes better to national development. A major task in delivering these mandates is creating an enabling regulatory and supervisory environment for innovation to thrive, so that new products and processes that fall into regulatory space of the SEC are recognized and adequately regulated while positioning the Nigerian capital market as a globally competitive market. 2, the rationale for regulation. When operations in the financial markets are optimized, they enhance welfare by delivering quality products and services that meet investors' needs. The rationale for regulation is therefore to curb unethical market practices while ensuring timely delivery of quality products and services. A study conducted by the Cambridge University George Business School shows that financial services sector is one of the most regulated industries, primarily due to the presence of a number of potential market failures. Thirdly, developing the derivatives market. Various studies conducted have identified a number of structural gaps seen as impediments towards the achievement of the long-term goal and objectives of the Nigerian capital market in its role as a catalyst for national development. Key among these gaps is market fragmentation and imbalance that showed significant concentration of market activity in the equity subsector, while market capitalization is dominated by a few companies in a few sectors. This development necessitated far-reaching initiatives to deepen and diversify the capital market through new products and services, including derivatives and derivatives trading. The global financial crisis of 2007 to 2009 presented a major event that shaped the regulatory environment of the OTC market. The G20 leaders set out to improve the OTC derivatives market by mandating all standardized OTC derivative contracts to trade on exchanges or electronic trading platforms and be cleared through central counterparties. The Commission, in its bid to develop the derivative segment of the market, adopted this model. However, unlike some jurisdictions, the OTC market in Nigeria had remained largely unregulated for some time. However, a series of initiatives have been introduced since 2010 to make it more transparent through the creation of a formal market for the instruments that were formerly traded OTC. Next, I'll talk about our regulatory framework. The quest for additional products in deepening the Nigerian capital market favored the creation of a derivatives market and the complementary creation of central clearing counterparties. After years of engagement and preparation, the SEC released its rules on CCPs in 2019, which ushered in a framework for managing risk, especially counterparty default risk, through netting and centralized risk and data processing operations. CCPs have played an important role in global financial markets through their activities, primarily to mitigate risk of a settlement. They have, however, become even more critical in financial markets, with clearing now globally accepted as an effective risk management mechanism. With the introduction of CCPs, participants in the exchange-traded derivatives markets do not have direct exposure to each other or several counterparties with different risk profiles, but to a CCP. Market-wide management of credit risk will improve as CCPs cover exposures with several risk management tools. Where a clearing member defaults or fails, CCPs are able to facilitate the transfer of positions and collateral of such failing clearing member to non-defaulting or solvent surviving clearing members, and coordinate the orderly placement of defaulted trades through auctions and hedging of exposures, thereby acting as a firewall. As the derivatives markets continue to grow, CCPs in Nigeria will become increasingly sophisticated and efficient. Regulation requires that CCPs must maintain adequate systems, capacity to process anticipated high volumes, and must be capable of protecting against threats to the integrity of their operations. Here, regulation requires proactivity. Insolvency and asset recovery was a major hurdle to the effective operation of CCPs in the markets. Ideally, preference is given to secured creditors in an insolvency, leaving market participants, especially account holders, at risk. As regulators, we have prescribed segregation of assets as a means of mitigating this risk with a regulatory tool in mind. in line with the provision. So I'll take that again. A means of mitigating risk with a regulatory tool in line with the provisions of the Investment and Security Act 2007, that's the ISA, that makes the monies in a trust account unavailable to the payment of an intermediary's debt. This measure was in addition to penalties for unauthorized withdrawals. There was, however, a conflict between these requirements and the Companies and Allied Matters Act of 2004 on secured creditors. Therefore, no one wanted to consider derivatives if this conflict was not properly addressed. Interestingly, the repeal of the CAMA 2004 and reenactment of same CAMA in 2020 addressed the critical legal deficiencies which impacted various aspects of the financial markets, including OTC trading. The netting and bankruptcy remoteness provisions cleared the path for greater strides in the derivatives segments of the capital markets. The Commission's central counterparty clearing house regulation became operational with the registration of 2 CCPs in 2020, providing a critical market infrastructure for the derivatives ecosystem to thrive. Next, I'll talk about regulatory expectations, which is one of the things that was highlighted. Our objective is that sufficient regulation and supervision will avert risks that may be associated with effective operations of the derivatives market and which may have strong potentials for heightening risks to the global economy, just as with the global financial crisis of 2008. It is expected that the services of the registered CCPs will help in deepening the derivatives market while placing it on the right path to achieving the required sophistication, depth, and breadth in terms of products and service offerings. Next, to talk about insolvency of market operators. The Commission is empowered to order a special examination of the books and affairs of a capital market operator under conditions specified in the ISA. Where it is determined that the CMO is likely to become unable to meet its obligation, about to suspend its obligation, or is insolvent, the Commission may take steps to prohibit the CMO from further collection of funds and appoint a manager over his affairs, among other measures. The Commission is equally empowered to take control of the property and affairs of an insolvent intermediary to ensure that adequate provision is made for repayment of investors. The SEC also has the power to appoint a receiver or liquidator over the affairs of such CMO. Next, we'll talk about the regulating fintech innovation. Financial innovation, which has been enabled by the rapid advancement in technologies such as cloud computing, blockchain, artificial intelligence, machine learning, and big data analytics, has led to the creation of a multitude of new business models, products, and services. While this disruptive phase comes with desired outcomes, such as adopting technology to open new markets, solving existing or new problems, and creating new products, there comes with it new areas of risk that can only be ignored at the peril of the capital market and indeed the financial sector. The Commission has been actively engaged in grasping the fast-paced and changing market and regulatory space in order to create an orderly market while facilitating innovation. Regulators worldwide consider various factors before adopting a regulatory approach to financial innovation. In some cases, the decisions go towards adopting a combination of approaches. This enables better options and affords the regulator better leverage. Major factors that determine this choice include the regulatory mandate, level of development, sophistication of particular jurisdiction, environmental factors, availability of resources, knowledge and capacity, risk appetite, and objective. And I'll just take a minute to talk about the journey so far. The Commission's journey on fintechs. The journey of the Commission's fintech regulatory effort started in 2018 by engaging key fintech stakeholders, having observed several fintech companies offering some kind of investment services to the public. And subsequent developments after this include the launch of the SEC Fintech Roadmap Report in 2018, inauguration of Fintech Implementation Committee in 2018 as well, creation of SEC's Financial Innovation Division, release of Statement of Intent on Digital Assets, which happened in 2020, registration of the first set of FinTech CMO, the digital sub-brokers, and digital portfolio managers in 2021, and the latest being the release of rules on virtual asset providers, operations, and operators in 2022. The requirements for the digital asset platforms revolve around registration, governance, outsourcing, risk management, trading, asset protection, market transparency, and anti-money laundering, among others. The issuance requirements focus on initial assessment filing, registration requirements, limits of funds to be raised, investment limits, and exemptions, among other things. Digital asset custodians will continue to play a key role in safeguarding investors' assets, which explains our insistence on high capital requirements and strong governance structures. And to talk on the bigger picture, the release of these rules have elicited both high enthusiasm and apprehension from stakeholders. We have received numerous inquiries and applications for registration. The Commission will continue its engagements with the relevant stakeholders to fine-tune its rules while putting up internal structures that will enhance operationalizing the rules in due course. The importance of homogeneity in the application of the rules and interagency cooperation cannot be overemphasized. The new CAMA 2021, the Finance Act 2021, the Money Laundering Act 2022, the Nigeria Data Protection Bureau Regulation of 2022, and the Insolvency Regulations of 2022 all have provisions that have sometimes require overlapping regulatory compliance. The insolvency regulations, in harmony with the CAMA 2022 netting and bankruptcy remoteness provisions, clarify compliance requirements for insolvency and provide a comprehensive governance and procedural framework for insolvency practice. This no doubt enhances both the sanctity of the financial contract, including derivatives, and survival of corporate entities, which are critical supervisory issues for the Commission. The way forward. The strong government focus, as outlined above, and the legislations reinforce our position to create a facilitative regime for new products, processes, and infrastructure that will ultimately result in positive developments in the capital market. However, we recognize and remain focused on the critical importance of protecting investors from cases of technology risks and failures. Regulating tech-based innovations seeks to create standards that encourage ethical practices to make for a fair and efficient market. In conclusion, I encourage all of you to take full advantage of this occasion to learn from and to contribute ideas towards our common goal of building a deep and vibrant market that provides greater opportunity set to all stakeholders than is presently the case. This event presents yet another platform on which market participants can network and discuss issues of concern to all. We should make optimal use of it. Once again, on behalf of the Commission, I congratulate the Association of Asset Custodians of Nigeria, AACN, for organizing this conference and wish you fruitful deliberations. Thank you and God bless. Signed, Lamido Abubakar Yuguda, CFA, FCA, Director General, SCC. Nothing added and nothing taken away. Thank you very much.
Good morning. Good morning, everyone, once again. And thank you for taking out time to attend the Annual Investors Conference. Thank you very much, the DG Securities and Exchange Commission, ably represented by the Executive Commissioner, Operations, Mr. Dayo Bison. We thank you very much for your presentation. It was quite enlightening. It was thought-provoking and very, very insightful. So we'll just delve straight into the Q&A session. From the audience, if we have questions, we can just put them in the chat box and we'll take them as much as possible as our time would permit. In the meantime, we have some questions for the Executive Commissioner. Okay, sir, what is the Commission doing to ease investment bottlenecks for both foreign and domestic investors? Are there any forthcoming changes that would impact both foreign and local investors? Thank you.
Okay, thank you. Thank you very much. So, you know, it's a continuous process of quickly identifying challenges where they occur and quickly putting measures in place to rectify those challenges, be they permanent or temporary or just situational. So I'll just say that we at the Commission, a couple of things in identifying means and ways of facilitating or increasing level of activity. It can be sectioned under two major things. They are like issues that fall under typical standard operational ambits. So a part of that is like increasing or facilitating or fast tracking time to market of transactions, for example. That is one. And that will come on two sides of the fence, making sure our own processes are more efficient, and we can just facilitate and make sure that more transactions make it to the market on time, so we can take advantage and benefits from that. Secondly, there are a couple of other initiatives that are more systemic that we've been able to address over time. I'll mention some. So, for example, the issue of unclaimed dividends, for example, it plagues local and foreign investors having access to your dividends as at when due. So it's not just having access to them, as quickly as possible. So you don't have to wait so long for you to get them. So, and there's been several initiatives over times past that have yielded some level of result. Of course, you keep improving and everything. Talk about direct cash settlement, having e-dividend mandates. And I think one of the core things I would like to mention here to the heart of that is just to make sure that investors are properly identified, just as you have the BVN, the banking sector, and the money market side. The Commission on its own, I think in 2021, we commissioned a committee, a market-led one, to even look at our a unique identification program for investors in the capital market, such that this issue of incomplete identification is a thing of the past, because it culminates into different problems like e-dividends, complaints about settlements, complaints about trade, and they're just generally helping us avoid, should I use the word, malpractices of malfeasance by anyone, maybe operators or some scrupulous investors. Now, secondly, and I think the other leg of your question is that, are there any other things that is being
any
done
forthcoming changes
that will be done by the regulators? Yeah, yes. Forthcoming changes. There are a couple of things that, should I call them changes? Because whenever we want to expose or make new changes, I mean, we will have avenues of intimating the market and all our operators through the Capital Market Committee meeting, which we hold every quarter, one of which will be coming up at the end of this month on the 24th and 25th, I believe. A couple of things have been done. Some of them are already operational, having to ease on crowdfunding platforms, because one of the things that local and foreign investors talk about is the depth of the market, having or creating avenues for more companies to be listed. And we know that despite or having, or in addition to different advocacy that have been done to encourage existing companies to come to the market, next thing is to build a pipeline through crowdfunding, pipeline of new companies that will be big and well structured enough to come on the listed market, so they can have their shares available for trading. So I wrote a couple of things that I thought I'll just mention, maybe not so much of news, just jotted a couple of things. There's, for example, in order to quicken and to accelerate the pace of transaction, other than or in addition to our own constant review of our own internal processes, to make sure that we quicken time to market. There's an initiative that we've been talking about and we've been toying around, and I think we're even closer to the end. That's like the deemed approval initiative. So, and this just, in essence, in summary, is just to make sure that transactions move faster. The responsibility of adequacy and sufficiency of information is on the issuer and then the issuing house. And that will sort of reduce the time transaction spend within the commission further, and will just allow the people on the one side requiring the money to connect with the people on the other side who have the money. And other things that are like really material, and I'll say a lot of things have been said around digital assets and technology and fintechs. Now, in addition, and it's very interesting or very, very good that we're talking about developing the market versus regulating the market. It's a very delicate balance. One requires the other. So if you don't have a developed market and you just focus on regulation alone, you just keep managing the little pool you have. And with time, that will become obsolete or will just die off, or will just shrink, and it will be irrelevant. Meanwhile, if you focus too much on developing the market and not regulate it, the risk attached to that will be so detrimental, it could just make rubbish of all the initiatives you have put together. And I wanted to say that there are a couple of things that the Commission is looking at on the virtual assets and the digital asset space. Should I say, fallouts or byproducts of that? We're looking at tokenizing different assets. Now, this is Hydra-headed, and those are some of the initiatives that we're working on. Tokenized assets will help you pick some of the assets that are initially or currently outside the capital market on stream. Two, will help you into other areas, just like people having some fractional shares or fractional ownership. That will include, it will just increase participation, and that will just foster and drive one of our own efforts in just driving financial inclusion in Nigeria through access to capital markets. I don't know how much time I've got, because I could actually go on and on about this.
Okay, yes, thank you. Thank you very much, Executive Commissioner, for that very broad perspective. I'll just go straight to the next question, then I will allow one or two live questions. So please, if you have any question, you can indicate by raising your hand and you'll be unmuted. But in the meantime, I'll just ask this second question while we wait for a live question, because we're really pressed for time, but we'll try as much as possible to still work within the time frame. Yeah. I think we still have like 5-10 minutes more. Okay, the second question, Executive Commissioner, as the apex regulator of the Nigerian capital market, how would you say you have fared with respect to regulations that support market development? Are you able to point us to a few of these recent regulations?
Okay. All right. Okay. Thank you for the opportunity of giving us our own question paper to mark ourselves, so we can rate ourselves. Because that puts you in a very, very tight position. To be honest, there's obviously room for improvement. I mean, being factual, what we've done. A lot has been done. A lot is being done. But you know, the taste of the pudding lies in its eating. If it's not being felt or seen to be done, that means you just have to gear up efforts. As regulators on our side, many fronts are being pushed. And in case, in the events, or should I use the word, we're in a dynamic world. Change is the only constant thing. So just as you are solving the problems which you foresaw, and I'll give an example of that, is the Capital Market Master Plan, which was drafted, wonderfully drafted. I think I said in one of the subcommittees at some point, it was well envisaged at 2015, but by the end of 2019, it was so clear that you can't be using that old script to live into the new realities we currently live. So as regulators, what we have done and we will continue to do is to make sure that we continue to adapt to the changes, to facilitate market growth, and to effectively regulate. Two things I'll just want to mention, Mr. Gundele, before I drop off on that question. is just to pay attention to the peculiarity of being a regulator in a very, very dynamic market. And I'll use the word dynamism for Nigeria because a lot of moving parts are happening. I'll give you an example. From the outside, when you read statistics, it says, oh, Nigerian investors are not, or the Nigerian investing public, so to speak, are not so financially literate. However, one of the more complex financial products, crypto assets, crypto trading, they rank 1 to 3. Is that not a misnomer? You know, as a regulator, you just need to balance it's out. So I think back to your specific question, how would you rank? How will I rank our own activity? I think I'll leave that to the market to judge, because we could just be doffing our hats, saying, okay, we are moving well, but the people or the markets or the community we are serving thinks there's a lot to be. And I mean, so I'll just leave it to the market and the community to rank us how we're doing, so we can take lessons from them. And I know a lot of things we've been going there, they are constructive criticisms, which we take very seriously and which we act on effectively. Thank you.
Okay. Thank you very much, Executive Commissioner. I don't know if there are live questions. I can't see. Timach, can you see if there's anybody raising their hands? Maybe we can just take one because of our time. Timach?
There's none. I think in the interest of time, we can take all those questions and circle back to the commissioner and then come back to the investing public. Thank you.
Okay. Thank you very much. In the interest of time, we really have to wrap up now. Our time is fast spent. So thank you, the DG, Securities and Exchange Commission, ably represented by the Executive Commissioner Operations, Mr. Dayo Bison. It was indeed a delight to have you here.
I think if you permit me, I think before I run off, just a quick opportunity to send a message that across the capital market, the role of asset custodians has been more pronounced, especially since we came into office, will be more pronounced. And we thank Association of Asset Custodians for putting it together. We've had a very, very great relationship, and we'll continue to do so. By some provisions of our role, I think 95.2, it will redirect a lot of, should I say, assets towards your custody. And just to leave it on the note that to whom much is given, much is very much expected. We thank the leadership. We thank you for the engagement so far. We see the works you've been doing, very professional, and the level how you've scaled up your technology, that is quite impressive. But please know the reward for good work is more work. There's a lot of more work to be done. There are more assets to be taken care of and well taken care of in the best interest of our investors. Thank you very much for the opportunity to speak.
Okay, thank you so much. Thank you for your views. Thank you for your comments. They were very helpful, and it definitely helped to set the tone for the other conversations that we'll be having later today. So thank you very much. It was indeed a pleasure to have you. Thank you. I pass the mic back to Timach. Thank you.
Thank you again, Mrs. Ogundele, and to our DG. Thank you for honoring our invitation. I mean, words on marble. It's a delicate balance. Can we have a situation where we regulate the market and we don't develop it? Absolutely not. They appear to be two sides of the same coin. So thank you so much, sir, for those thoughts. Ladies and gentlemen, we have the agenda for the entire conference. A link will be posted in the chat box. You could click on it and have access to the virtual agenda and the entire pack for today's session. We're trying to save the earth, and so we're going fully digital at today's virtual conference. Thank you very much. Next on, as part of our agenda, is to hear a keynote address from the CE and the Executive Secretary of Nigerian Investment Promotion Commission. It's important to note that the commission has, as part of its mandate, to ensure that the environment, the investing environment, is sufficiently enhanced for investors to come into Nigeria and ultimately see Nigeria as an investment destination of choice. Ms. Saratu Umar is the executive secretary, and she's also the chief executive of NIPC. She was appointed on July 5, 2022. She's been in the market for a while, over 30 years experience in banking, investment banking, and also consulting. And she's pitched her tent in the public side of life, and that's why we have her here. But just before she speaks, we are going to have the national anthem, given that she has in her mantle and on her shoulders the strength of the government. So we'll have the national anthem of the Federal Republic of Nigeria, and then she will take on the virtual lectern to give her keynote address. Thank you.
Are we to gently sing? Are we to gently sing?
Distinguished participants and speakers, good morning, good afternoon, and good evening to you all in whatever part of the world that you are. It is indeed my honor and privilege to be in your midst today. And indeed, it is an honor to be asked to deliver the keynote address at this annual Nigeria Investor Day conference, organized by the Association of Asset Custodians of Nigeria, AACN. I congratulate the association for organizing this conference, which provides a platform to enhance the knowledge and confidence of local and foreign portfolio investors in the Nigerian capital market, raise the visibility of Nigeria in the international market, and also create a networking platform for custodians, fund asset managers, broker-dealers, registrars, regulators, government officials, local and international investors in the Nigerian market. This conference is laudable and timely. As a theme, Nigeria, capital flows, investment, and regulatory landscape is facing the nations of the world, which include post-COVID-19 challenges, the slowdown in the global economy, existential challenges with climate change and energy, amongst other capital flows. It is topical to Nigeria's capital flows because the situation is further compounded by the concern of investors around the liquidity in the foreign exchange market and a decline in foreign exchange importation from oil and gas, arising from low exports, oil thefts, and so on, which have affected a huge chunk of capital flow to the country. Government recognizes the daunting challenges, especially the declining capital flow, and has put in place a number of reform initiatives which have recorded some successes, resulting in modest improvement of the business climate, and is still committed to continuing with some of the ongoing reforms in some key sectors of the economy, which include infrastructure, power, transportation, ICT, oil and gas, and agriculture, amongst others. Government is fully aware and mindful of the concern of investors, and particularly portfolio investors, around liquidity in the foreign exchange market. It is noteworthy to say that the Central Bank of Nigeria is not relenting, but fashioning out ways to address this challenge. Additionally, improving the ease of doing business is an issue that the highest level of government has taken most seriously. Being mindful of the fact that improving the business regulatory environment across Nigeria is key for the country's economic growth, the Presidential Enabling Business Environment Council, PEBEC, was inaugurated by the President of the Federal Republic of Nigeria, President Muhammadu Buhari, GCFR, and it is chaired by the Vice President of the Federal Republic of Nigeria, Professor Yemi Oshibajo, GCON. PEBEC was set up purposely to drive the removal of critical constraints and bureaucratic bottlenecks to doing business in Nigeria. With the setting up of PEBEC in the last few years, the business regulatory reform agenda has taken an all-inclusive approach with the involvement of the federal and state governments in the design and implementation of reform initiatives. Accordingly, Nigeria has moved up 39 places in the World Bank Doing Business ranking since 2016, and has improved 11 places in the World Economic Forum's Global Competitiveness Rankings within the same period. In the World Bank Doing Business 2020 report, Nigeria moved up 15 places to 131st position, was named one of the top 10 most improved economies for the second time in 3 years. In addition, various measures have been taken by government to still improve the investment climate, as well as address the declining capital flow, especially from the oil and gas sector, by the enactment of the Petroleum Industry Act, PIA 2021, which provides legal, governance, regulatory, and fiscal framework for the Nigerian petroleum industry, and the development of host communities also. PIA is also aimed at encouraging investment in the oil and gas sector of the economy. Again, the Companies and Allied Matters Act, CAMA 2020, was enacted to provide the legal framework for the reform of specific regulatory and administrative bottlenecks, which have before now limited the formation and operation of businesses in the economy, particularly micro, small, and medium enterprises. Also, the Finance Act 2019 and 2020 were enacted to provide additional support for addressing the challenge of dominance of government in the economy and to encourage more private sector participation. The National Development Plan 2021 to 2025 has been developed to run a public-private partnership policy plan. While government is expected to provide 49.7 trillion or 14.3% out of the total required investment of 348.1 trillion, the private sector would provide the balance of 298.3 trillion or 85.7%. This implies that successful implementation of the plan would require a strong partnership between the public and private sectors. The National Development Plan aims to tackle the obstacles hindering the competitiveness of Nigerian businesses, notably the infrastructure deficit and the challenging business environment. During the plan period, government will focus on sectors with great potential to generate jobs for our people and with multiplier effects in other sectors. It will continue to encourage investment in critical infrastructure such as power and alternative energy, rail, roads, and housing, and ensure macroeconomic stability, enhance the business and investment environment, and improve the living conditions of Nigerians. As you may be aware, as a way to ensure more transparency in business entry processes and simplify administrative procedures, there's a one-stop shop investment center at the Nigerian Investment Promotion Commission, NIPC. OSIC is an investment facilitation strategy to bring investor-facing government agencies to one location to ease the burden of approval formalities. NIPC is a federal government agency established by Act 16 of 1995 to encourage, promote, and coordinate investments in the Nigerian economy. NIPC is Nigeria's investment promotion agency and the gateway to the Nigerian economy for investors. It is mandated to coordinate and monitor all investment promotion activities in the Nigerian economy and to provide all incoming and existing investors assistance that they may require. NIPC, pursuant to its mandate of promoting investment in and outside Nigeria, has over the years initiated, organized, and participated in promotional activities such as conferences, seminars, and international businesses and investment fora to stimulate and attract investment, including also going on investment roadshows along with the Nigerian Stock Exchange. Permit me also to state here that in addition to promoting investment, NIPC assists investors to navigate challenges in investing in Nigeria, assists also with connecting prospective foreign investors with domestic partners, assists investors with quality information to help them implement their investment plans in the country. We also provide the OSIC Lab, which is a platform for solving challenges arising from investing in Nigeria or from the implementation of government policies. Distinguished participants, ladies and gentlemen, NIPC has a critical role to play in the nation's quest for increasing capital flows by attracting investments, especially foreign direct investment, to generate employment, create wealth, and unlock the value chain in various sectors of the economy. NIPC has therefore prioritized mobilizing investment into the import substitution and export diversification sectors and is collaborating with relevant stakeholders to promote and attract the investment into Nigeria. Our aim is for portfolio investors to have so much confidence in investing in Nigeria that they transcend from being just portfolio investors to direct investors in the Nigerian economy. I wish to reassure you, distinguished participants, that efforts have been intensified by government to shore up the non-oil export base of the country to further diversify the revenue base and increase foreign exchange earnings of Nigeria. It would interest you to know that between January to June rose to $2.5 billion, the highest since 2018. And this translates to more non-oil exchange revenue in the immediate term. But I can assure you that in the medium to long term, it will be confined to the archives of history. As the ongoing efforts by arms of government, particularly the synergy between the Nigerian Investment Promotion Commission and the Export Promotion Council of Nigeria, amongst other stakeholders, will translate to increased non-oil exports of the Nigerian economy. Distinguished ladies and gentlemen, in conclusion, I crave your kind indulgence to once more remind you that the government of Nigeria identifies with portfolio investors on the challenges facing them in the capital market, and it is committed to addressing them. Government has put in place measures and is still working assiduously to make the investment environment more conducive and rewarding for portfolio and indeed direct investors. Again, I commend the organizers of this conference for the efforts they have put in to bring together these distinguished participants from across the globe to enhance their knowledge and confidence in the Nigerian capital markets. It has been an honor to speak with you, and I thank you for your kind attention. Thank you very much.
Thank you very much, Hajia Saratu Umar, for that succinct and quite detailed keynote address. I think there's a lot to decipher from it. And maybe, ladies and gentlemen, just to mention to you that the copy of that keynote address will be shared with all participants. It will be hosted on our website, the website of Association of asset custodian for your reference purposes. On that note, on behalf of the AACN, Haji, I would like to thank you once more for taking out time to be with us this morning, afternoon, evening, wherever our investors or clients are dialing from. And we do hope you would be kind enough to accept the gesture of our invitation in future. Thank you very much, Haji Saratu.
Thank you. Thank you.
Moving quickly, we'll be heading to the other item on our agenda. We can't have a conference such as this without, understanding the context called Nigeria from a macroeconomic standpoint. So it's important that we delve into that conversation, and we have someone who is adequately skilled to help us navigate that water. This is Mr. Bola Taiwo. He's the Chief Economist for Africa at JP Morgan. He'll be joining us to share his views around the macroeconomic view where Nigeria currently stands, as well as charting a course into the future and talking about the impact of the political activities on the capital market. Also joining him from a rapporteur perspective will be Mr. Babatunde Ogunlewe from RMB Nigeria. The floor is yours, Mr. Bola Taiwo, and thank you for accepting to be with us this morning.
Can anyone hear me?
Yes, we can.
Oh, so you were not hearing me before. Apologies. Okay. I was saying thank you to the leadership of the AACN for this opportunity to share my little knowledge of at least what I know about the Nigerian economy. Am I able to share my screen? Is that possible? Okay, let me see if I can make this work here. I believe my screen is visible now. Can anyone see my screen?
Yes, we can.
Excellent. So thanks again. The way I'll go about this might be a little bit different. I'll talk about Nigeria at some point, but what I want to do is set the backdrop with sort of what we've seen on the global stage, and then bring it closer to what we've seen in the region and frontier markets, and putting Nigeria in the bucket of SSA and frontiers in general, and basically saying how Nigeria has fared compared to the rest. And then the last couple of slides would then be to talk through sort of the main themes that we see developing stories in Nigeria in general, and how we see 2023 shaping up, basically. And it's no gainsaying the fact that, the whole world has been through adverse and multiple shocks in the past few years, right from COVID in 2020. And now we're talking about, Russia's invasion of Ukraine that's led to commodity price shock and has impacted, several economies differently. But I think from a global perspective, what has been more critical is how we're looking at the impact of all of these shocks on a particular variable in inflation, and how that will be affecting economic growth as well. So largely, you've seen crude prices at record highs this year. You've seen gas prices as well. You've seen agricultural prices as well. You've seen, to an extent, if you look at just the charts just right beside it, manufacturing output, decline significantly in 2020 for the rest of the world, including China, and just starting to pick up, and then you have another shock. And of course, headline inflation has been the major point of call, which has obviously led to significant reactions from central banks across the globe. And the question then becomes, the balancing act between inflation and growth. Are we going to see, central banks literally induce a recession here because of the significant global monetary policy tightening that they're currently on? Of course, the impact of that is the sort of flows that you will see come through to emerging and frontier markets like Nigeria. And of course, that has been telling the sort of the spreads that we've seen in the bond prices. But the key question remains, are we heading towards a global recession? Is the US Fed going to stop at some point? I mean, I think our forecasts now are pointing to a reduction in the pace of the acceleration of the global tightening, particularly from the US Fed. Just recently it was 75 basis points. The expectation is that perhaps in December it drops to 50, and then you do another couple of 25 basis points early next year. But again, is that going to lead to a global recession, particularly because the US is not just the one tightening? You've seen a lot of global central banks tightening. The Bank of England is tightening. ECB is tightening as well. And then on top of that are we going to also have the supply shocks that have been induced even over the past few months as well, in fact, and then you see a significant slowdown in terms of economic growth, which again could give us a precursor to what we could potentially see in the years ahead. But for us, we think that there could be a soft landing-ish, right? In how we look at the global environment. I mean, the risk of recession, are high for sure. But we think that we might not get there to a global recession. I mean, I think our US economists are forecasting that you'll probably see zero growth in the US in Q3 23 rather, and Q1 24. And then you probably see the bounce up again from there, and might not particularly lead to a global recession. But what is clear is that, the world economy is slowing, the global economy is slowing down. Part of it is being induced by the significant monetary policy tightening. And I guess the tightness of the labor market in the US still allows the Fed to still be able to at least continue at some pace of tightening over the foreseeable future. There would be inflation print in the US today, and I guess that could again give a better sense of where this could be headed. But the clear direction of travel here is growth is slowing down, inflation is high. Hopefully, if you get commodity prices to start to cool off, you could start to see inflation come off into 2023, as the chart here shows. So if I move,
Mr. Taiwo, can we have it on presentation mode so that we can follow the slides? Yeah, thank you very much.
It is on presentation mode. You can see it is on presentation mode. Are you not seeing the slides as I'm moving through it? No,
we're not. It's still on the first slide, which is the macroeconomic.
Is it moving? I mean, it's moving. Is it moving now?
Yes, it's moving now.
Okay. I guess let me switch this again. So can you confirm that it's still moving? Like I'm scrolling through now. Can you confirm it's still moving just to be sure?
Perfect.
Yes.
Perfect.
Okay, awesome. Also, you've not been seeing my slides. Apologies for that. So anyways, I'm not going to run through them again, but basically it was the backdrop of the global environment that I was speaking through just now. And then I talked about the recession risks and whether it's going to be central bank induced or not. And then that basically dovetails into what we think is going to happen, whether it's going to be a global recession or not a global recession just yet. But the risks are obviously, pointing in the direction that the global economy is going to slow down significantly. So if I move now forward to what's happening closer to Nigeria and closer home in terms of SSA economics, right? So you've seen, the commodity price shock has impacted a lot of these economies in diverse ways. Obviously, the immediate gainers you want to think about are the oil and gas exporters, right? So Angolas, your Gabons, your Nigerias, and to some extent as well your Ghanas. If you look at the chart on the left, there basically shows that the net export or the net trade in oil and gas for a lot of these regions, and you clearly see the people that are an advantage. Obviously, the guys at the economies at a disadvantage are sort of your East African names, Ethiopia, Kenya, Uganda, and which are primarily net importers of commodity. But the picture is actually quite different when you look at the other chart, which is considering the twin balances, right? And Nigeria again features quite prominently here. Even though you're seeing, a current account surplus for a country like Nigeria because it's a big commodity producer and a big commodity exporter, the fiscal balance has not improved materially. And I'm sure at some point in this presentation or in the course of the discourse, we'll talk about, what exactly is driving that. But when you add those balances together, which is the fiscal and the external balances, Nigeria is still in the negative because there's a big pull from the fiscal side. And that's largely because despite, the improvements we've seen in oil prices, we can talk about lower oil production, subsidies, that is not allowing the fiscal situation to meaningfully improve. And for most in the region, there has been that element as well. So some, are employing subsidies, to be able to limit the impact on the population. Some, have to, put in direct transfers in to be able to limit the impact of the population. So you're seeing fiscal even get wider during this period. But overall, the picture in general doesn't exactly look like it's an improving story as it were, even despite the oil price shock. I think Angola is the clear leader there that is running a twin surplus there with both current account and fiscal surplus. And of course, the next thing to consider here is what exactly has been happening to flows, right? So when you look at it on the external side and looking at the current account balances and what is happening, the other side is the financial account, and basically understand what has been happening to flows given that global backdrop we've painted. And as you can see for virtually all of the charts here, it has been largely a declining trend from foreign direct investment to foreign portfolio investment. Nigeria at the bottom left chart, you can see portfolio investment tends to be a key driver, but they tend to be very volatile as well. And not just in Nigeria, across most economies, when there's a risk-on environment, everyone is happy. There is inflows. When there's a risk-off environment, you see the other side, and you've seen, economies like Egypt, Ghana, face significant pressures from a currency perspective this year on the back of all of these significant outflows that you've seen. So, remittances still remains the clear leader for most of the region, even for Nigeria as well. And then at that point, it's always sort of consistent and flattish for the most part. I don't think you see a significant jump in remittance flow. And that's why when you look at the line there, it's mostly almost flat as a percentage of GDP. But clearly, FX flows have dwindled as well. And then add that on top of what you have seen on the current account side. And what's the picture? The picture is that you're going to see currency pressures, and you're seeing that significant currency pressures and reserve depletion for a number of these economies. The Nigeria chart there shows less than 10% depreciation of the currency this year. That's using the NIFEX rate, but I'm sure a lot of people would say use it when you consider what's happening in the parallel markets. It's a different story, and you've seen significant depreciation there, and that is more what perhaps has been passing through to inflation. So I think the picture here is clear. Given the commodity price shocks, you've seen pressures for net importers. You've seen pressures for commodity exporters as well, particularly on the fiscal side, and you've seen currency pressures impacting a huge number of these economies across the region, and Nigeria, of course, features quite prominently there. And ultimately, this has forced a reaction, right? And you've seen a significant reaction from global central banks, from African central banks. I think when I look at the pace of rate hikes and monetary policy tightening that we've seen even across the continent this year, it's been unprecedented. Typically, we always talk about the weak transmission mechanism of monetary policy in the region in general and Nigeria as well. What we've seen the Central Bank of Nigeria act, over 400 basis points already this year. Ghana has done significant hikes, as you can see on the chart. Of course, Ghana is facing significantly high inflation. Inflation now is above 40%. So you've seen that across, I think the only country in my mind that, if I can remember, that hasn't hiked policy rate this year is Zambia and Angola. And that's largely because for them, they are on the other side of the spectrum where they saw significant currency pressures most of last year. Now those currency pressures are easing, and inflation is actually coming down rather than going up. So they sort of bucked the trend, but largely the direction of travel for most of these guys has been aggressive monetary policy tightening. But again, it's one thing to continue to tighten significantly. It's another thing to actually think that monetary conditions, or to actually get monetary conditions to actually be tight. So when we consider where monetary conditions are in actual fact, across the region and in Nigeria in specific, we still think monetary conditions are fairly loose. I mean, you can use different indicators, right? You can use your real monetary conditions index to try to figure out, where do you actually think real monetary conditions
Mr. Akbolawan. Sorry to cut you short, but I think your slides are not moving again.
Oh.
Yeah. So I think most of us are still stuck on the third slide.
Are they moving now?
No, not yet. It's still stuck on the third slide.
Now?
Nope, still the same thing. Okay, yeah, it's moving now.
Is it
yes,
moving?
we can see the fourth. Yes, it's moving now. Yes, thank you very much.
Yeah, I mean, I think I have like the slides open on all of my screens right now, and actually I don't know which one is working. Okay, I'll try this other one then. It seems this one is the one that is working. Please just confirm it's still moving. So I'm moving through the slides now. You can still see them.
Yes, I can still see the movements.
So yeah, we should be on slide 9.
Oh no, we are on slide 8 now. Okay, now it's on 9. Yes, but we can still see it moving.
So now it's on 9. So 9 was where I stopped, where I was talking about the aggressive hiking cycles that we've seen across the region, and with the exception of Angola and Zambia, they haven't acted. And slide 10 is where I am now. Please confirm you can see slide 10.
Yes, we can see slide 10.
Great. So slide 10.
I think it's still not in presentation mode. I don't know if you can move this screen to presentation mode so it can be bolder.
Just give me a second, because I have 2 presentation modes on right now.
Oh, I think you've stopped sharing your screen.
Yes, just give me a second.
All right.
Sorry, I'm not very tech savvy. Okay. Can you see the screen now, and is it in presentation mode?
Oh, perfect.
Yes.
Perfect. We can see it clearly now. Thank you.
So am I on slide 9? Am I on slide 10?
Yeah, the title of the slide you're on is Forcing Aggressive Monetary Tightening Amidst Incessant. Okay, but you've moved over. Yes, you're on slide 10.
So I'm on slide 10 now. Okay,
yeah,
perfect. Hopefully this works now. Sorry, apologies for that. I thought I was actually moving, but I was talking to the slides by myself. Where was I? Monetary conditions. So I think, we've talked about weak transmission mechanisms across most of the continent, right? And Nigeria clearly features prominently in that regard as well. We've seen consecutive hikes from the Central Bank of Nigeria this year, but when we try to assess where the monetary policy conditions are in terms of, is this going to be very impactful in tightening, or is it going to have the intended impacts, we still find monetary conditions to be loose. And that's a function of a lot of things when you consider the significant funding of the government, fiscal funding of the government from the central bank, and you consider that, real policy rates are still in negative territory. All of these are still factors to consider in terms of thinking about the impacts or how much impactful monetary policy tightening can actually be. So that's a key concern. And it's not just in Nigeria. As you can see, even Ghana, we still think the monetary conditions are stimulative, even despite the significant hikes that the Bank of Ghana has delivered there. But we think that, from a policy point of view, we think the central bank will continue with its tightening pace, and we'll probably still see, a couple of more hikes, this year and into early next year. I believe the slide has moved. I hope it has moved. The other part of the conversation, of course, is what is happening with inflation, and particularly food inflation. And you've seen that jump quite significantly this year across. But there is little, monetary policy can do to tackle inflation. For Nigeria in particular, you talk about, the instances of flooding that is impacting the agrarian community. You talk about the instances, of the infrastructure, getting the crops from the north to the southern part of the country and what have you. All of that will still remain a concern from an inflation point of view. And in my mind, it's probably just a way to allow it to run its course at the end of the day. And I think finally on this point on the regional themes here is, what do we think about economic growth and with what the IMF thinks about economic growth? The IMF thinks, growth will still remain fairly subdued this year. And even going into next year, looking at about 3.7, which is sort of below the trend average for SSA in general. In Nigeria in particular, I'm not very great at geography, but I think Nigeria is somewhere there, and I think it's the 3% there that you see that the IMF, is expecting growth to be for next year, and I think from about 3.2% this year. I mean, for us, it's slightly a bit more optimistic from the growth dynamics. We think the election spending will spur some activity a bit. There's still a big informal economy to consider in Nigeria. You need to have key sectors that will continue to contribute. Agri sector, the ICT sector, that will probably still continue to contribute, perhaps to different variations over the coming quarters, and that would be to some 3.4-ish% growth from a growth perspective. But in general, across the region, you are seeing that growth should slowly start to pick up for most of the time. And to talk about Nigeria more specific issues, I'll pick up from where I stopped on the monetary policy point. Our view clearly here is that there would be hikes. There will be continued, tightening from the central bank via ad hoc CRR debit or, interest rate hikes. But the key concern remains, what's the effectiveness of the monetary policy tightening, right? Because when you consider that on one hand, the central bank is trying to tighten, on the other hand, they're still very simulative with the fiscal deficit financing. I think data as of September shows that the ways and means this year have been about 22 trillion already. The government already has intentions to convert that to long-term bonds on the central bank's balance sheet, 40-year bonds. We'll see how that plays out eventually. But clearly, there has been significant pressure on the revenue side that continues to allow the central bank to continue to finance the government to this magnitude. But we think that there is this multiplicity of objectives, if I can use that word, would perhaps continue to limit the intended impact of monetary tightening, and hence, you probably will not see inflation, fall meaningfully, owing to the CBN's actions. I think what has been more recent in that the central bank, the actions that the central bank has taken, is trying to demonetize, right? Basically taking the cash in circulation and trying to sort of reflate the economy with new currency notes and new redesigns. I mean, the view there largely is, on paper, it's a good initiative. I mean, on paper, you can think about all of the positives that could come across, different economic variables. From an inflation point of view, if you reduce sort of the cash, whatever, you can see some positive impact there. From a fiscal point of view, if you're able to get, more of the informal economy into the formal economy, then you can see some positive impact on tax revenues from the government. But I think the concern, and of course, you can talk about the cashless economy, which the CBN is trying to promote as well, and digitization of all of these avenues. But I think, the question here is it going to work? And I think that's the more critical question. And, India did something similar in 2016. And I was looking at, the sort of, how did it go? You saw the big drop in cash in circulation, just around the period they did it, but now they're back up to levels, and in fact, even higher. So I think it's going to be difficult to sort of change behavioral patterns of households and corporates that are already in the informal economy, except you put, very, very restrictive measures to allow them to do so. So I think that's going to be a concern, and that could be potentially an impediment to the CBN achieving its desired objective. with this new initiative. But I mean, it's on paper it's a good theory, but I can't point to one country that has been able to do it and has done it, successfully and achieved the aim it wants to. So that will continue to be a concern. From the external point of view, Nigeria continues to run a current account surplus, but reserves remain under pressure. And as you can see on the chart in the lower left corner there, I think this is likely going to continue, right? We've talked about oil production being lower. We've talked about, the continuous use of subsidies and the impact of all of that, and basically lack of FX liquidity in the FX market. And I suspect there's probably going to be a lot of questions around FX, and we can come to that at some point. But at the end of the day, the external environment, even despite the current account surplus, doesn't seem like it is very great for Nigeria, given the continued pressures you see on external reserves. The last point I'll make will be on the fiscal. Revenues are under pressure. Interestingly, non-oil revenues have done very well. I think, in fact, non-oil revenues are above target for the year. But of course, all revenues have been the major drag, and basically owing to the aforementioned factors, oil production being lower because of theft, swap subsidies, and what have you. The final point, before I hand it over, because I have the tendency to keep talking and not stop, is the 2023 elections. And who is going to win the elections? Obviously, I don't know. But I think there are a few dynamics that I think could be at play here. I have had conversations over the past few weeks and months as we start to see, manifestos come through. But purely from a manifesto point of view, I don't think there's anything. I haven't seen anything that jumped at me as, something particularly reformist from any of the key candidates. But I think in terms of how this could play out, you could potentially see a situation that it could get to a runoff eventually. Because while you have the two main candidates from the ruling party and the main opposition party, I think you have both a third force and, in my mind, a fourth force as well. I think the candidate of the NNPP and the candidate of the Labour Party, which could potentially eat up votes for the two top candidates in different regions. But in my mind, I think my best case here is still that it is going to be either the APC candidate or the PDP candidate that eventually wins. But their votes is probably going to be eaten up by the third force and the fourth force, in my mind, in different regions. The fourth force, the NNPP candidate, perhaps takes up some votes in the northern part of the country. That's if, one of the parties don't sweep him up before the elections. And I think the Labour Party candidate is probably going to take, some southern votes-ish from this candidate. So eventually, we could end up in a situation where, both or the leading candidates are not able to fulfill the requirements to get through the first round, which is, win majority of the votes, and I think at least 20% or 15% of 2/3 of the state. So I think that could be a potential outcome there. But in terms of what we expect, I think what we think should happen, the reforms are clear. On the fiscal side, subsidies, get our production back up. Those are the quick wins. The more medium term, then to see how to attract, direct investment, portfolio investment more sustainably into the economy, and ultimately improve lives and livelihoods of the people. With this viewpoint of mine, I hope I've been able to convince you or maybe confuse you. But thank you very much for your time.
Thank you very much, Mr. Agbola, for your time as well. And I think the presentation has been quite insightful and also packed with, a lot of important information. So I think I have a couple of questions for you then. I can see also we have, I think, 1 or 2 questions from the audience in the chat box that I will be asking you as well. So I think one of the things you did mention or touched upon was what was it now, that the monetary policy stance of major monetary authorities around the globe. I think it's quite important. That's something that's been a central theme in terms of macroeconomics discourse in a while. In your view, and I mean, if at all, if it's just from a theoretical point of view, how do you think emerging and frontier markets like those on the continent, particularly Nigeria, how do you think we're going to be impacted by this tighter monetary policy stance in developed markets? So yeah, I think we'll start something.
Okay, I mean, I think we're already seeing the impact, right? And I think the impact is very visible in the widening of the spreads, the bond spreads, Euro bond spreads now that you've seen across, not just in Africa, but in the continent in general. When I look at the spreads, and this is something I look at every month, when I look at the spreads, there is almost no African country, perhaps except from South Africa and maybe Cote d'Ivoire and Senegal, that can come to the market right now to issue Euro bonds. They can't. Nigerian bonds are talking, 13, 14%. Ghana, let's not even go there. Egypt is, talking, similar levels. So that has been the impact, the immediate impact of the global financial tightening, is the wider spreads. And that basically comes from the fact that in this sort of environment, what you tend to see people is, it's a risk-off environment. People tend to go towards, more riskless, if I can use that word, assets. People tend to chase the dollar more, and the dollar, as a result of the global financial tightening, has been strengthening significantly this year as well. So people, for now, will stay safe in the sort of dollar assets, in the dollar economies, as opposed to, taking up the more risky assets. The other side of the divide is, again, linked to the external financing gaps or financing conversations for a number of these countries. A number of these countries are facing significant pressures now where, there are now conversations of a lot of them, going to the IMF for bailouts. There are conversations now around debt restructuring. And what basically you would see is that you wouldn't see a lot of fund managers, wanting to touch those sort of names, except for fund managers, obviously, that invest in sort of the distressed names. So, I still have conversations about, people talking to me about investing in Ghana, Sri Lanka, Pakistan, very distressed names that you have in the frontier space. So that is the immediate impact that you see. External financing would be tougher. Not because they can't get the money, but they're going to get at a more expensive rate, and it just means that they're not going to be able to afford, the debt, and to worsen debt sustainability for most of these countries going forward. When you take it a step further to what you expect from portfolio flows, if they're struggling to invest in the dollar assets of the country, they probably are not going to be quick to come back. And again, you want to talk about the environment that is in place. Nigeria, I think, has more idiosyncratic factors in the sense that, the FX is probably not where investors expect it to be. Interest rates have been increasing over the past few months, but they're probably not what investors expect it to be as well. So Nigeria has its own idiosyncrasies in terms of how investors are viewing the investment environment there, perhaps compared to an Egypt where, they're making some moves in recent times and investors perhaps are looking again. But yeah, I think that's the significant impact that you're going to see of all of these global financial tightening. But the good news is, it seems, going into next year, the pace of tightening might start to reduce. Hopefully, if you start to get global inflation coming off of his peaks, then the Fed might start to slow down, and other central banks start to slow down as well, as they start to give more consideration to growth. Then maybe you can start to see those spreads tighten again, and maybe some of these countries might be able to come back to the market.
Wow. All right. Thank you very much. I think I do agree with you on your views in terms of what the cost of borrowing will be, and also particularly, what we're already seeing in terms of bond spreads. However, I think as more or less like a follow-up, I think one of the things you did mention while going through your presentation is the fact that you think that we may begin to see a reduction in terms of the stance of monetary authorities around the globe. What exactly do you think is the time frame before we begin to see a reverse in terms of the effect we're feeling within the continent? And also, I think in terms of Nigeria, particularly, I want us to be particular about Nigeria now, and also to reference the specific idiosyncrasies you mentioned earlier. Do you think that when things turn around in the global space, we will be able to, things might turn around also in terms of Nigeria's ability to go back to the Eurobond market?
Yeah, to the other part of your question on the global front, I think, it's a difficult question to answer. It's a difficult question to answer. It says that you need to be able to figure out where you think peak inflation would be, peak interest rates would be, and where you think global recession is going to happen, right? So it's a balancing act for these global central banks, right? we'll get the US inflation print at some point today. If it begins to show signs that inflation is cooling off, then it allows the Fed to start to slow down the pace of tightening, right? They won't stop tightening just yet. They will still continue to tighten, but maybe not do 75 basis point clips anymore, maybe downshift to 50 and then maybe downshift to 25. But if, again, you start getting into next year and the Fed is still tightening and, labor market is not as tight anymore, you're actually seeing the economy slow down more meaningfully, that now we now have a global recession in the forecast, then maybe the Fed stops earlier than scheduled. But I think the guidance clearly from the Fed after the last meeting was that, yes, they could potentially slow down, but peak rates might be higher than what the market is pricing at. So there's still a delicate balancing act. But all in, when I look at all of the forecasts, the expectation is that global inflation should start to trend meaningfully downwards from next year. So to the second half of next year. So in my mind, from a Nigeria perspective, when can Nigeria come back to the market? I'll say at best the earliest will probably be in 2024, when it is clear that either the recession is happening or it is clear now that the Fed or the global central banks are going to are actually on that path to bring in interest rate down. Then you get the spreads to tighten a bit, and maybe, I don't think Nigeria wants to issue at above 10%, right? I don't think they want to. I don't think they should, right? So the question is, when do those yields come back to below 10%? And I think that you're probably thinking about a year and a half from now, depending on where the data leads us from the global inflation point and the economic recession. Just the second part of your question was about, I think it was about when Nigeria can come to the market, right?
Yeah.
Okay.
Yes, that was it. Thank you very much once again. And I think one more question from me, or my penultimate question rather, would be, what do you think it will take? Based on all what you've said and based on the situation in Nigeria presently from a macroeconomic point of view, what do you think it will take to attract a lot more long-term and stable capital flows into the country?
Yeah, good question. I think what's clear is, portfolio flows are not the way. And I think I had a chart earlier that showed how volatile portfolio flows have been, not just in Nigeria, across the continent. Egypt is a good example of this. Egypt, relied on portfolio flows significantly over the past 2 years. They had 30 billion of portfolio flows in 2020, 2021. And March this year, basically more than half of it went out. It's over $20 billion of outflows. And now speaking to Egyptian authorities, it's obviously now they're considering we need to get, to your point, more sustainable flows into the market that are not cycle dependent. So when there's a risk of environment, they go out. When there's a risk on, they come back in. So it is clear that a number of economies in the region, and in fact, even Nigeria as well, I've had the central bank governor say this a number of times, that they need to start moving towards more sustainable flows, and i.e. that will go more into the foreign direct investment. And I think the NIPC chair, made a comment earlier in our presentation that, foreign direct investment are something around $2.5 billion now, which is, a vast improvement from where we are coming from, in the past couple of years. So I think that's the way to go. But, those investments are not just going to come by themselves. You need to implement structural reforms in the domestic economy. You need to continue to create domestic policies that will continue to be attractive to foreign direct investment flows. So basically, you just need to create a conducive environment for private sector investment and foreign direct investment flows to thrive. And I think that is the way to go. And that tends to have, a more significant impact in terms of ripple effects in the economy, because you get production up, particularly if you're attracting into, key sectors of the economy. So if you're able to attract, say, agriculture, for instance, or petroleum refining, as you probably start to see with the Dangote refinery, a lot of these things, you would start to see the benefits. Economic growth will be impacted, employment will be generated, and ultimately it's going to be for the better good of economy, not just on the FX flows. But I think that obviously is the way to go. But you need structural reforms. You need domestic policies that are targeted at key sectors that would actually attract these investors, both on the private sector side and foreign direct investments.
Wow. Okay. Thank you very much for that. And I think also, just as a follow-on question to this, I remember I think you mentioned something around domestic policing. And so I think my next question is going to be, what part of the economy do you think will be most important, or should I say pivotal, in terms of domestic policing, if we really are going to achieve this objective of attracting a lot more long-term and stable capital flows to the country?
I mean, I think I've mentioned this a couple of times. I think agriculture is that. I mean, and I think it's clear, and I was listening to, I think, one of the contestants last week on the presidential debate, was it? And one of the contestants, I don't remember who now, was saying, the Nigerian economy is diversified, it's just not productive. And he's right. When you look at the GDP of the country, agriculture contributes over 20%. And then from agriculture, you're then talking about ICT, trade, and all of those things. But when you go to the other side and look at contribution to exports, agriculture is nowhere to be found. Absolutely nowhere to be found. Oil is still 80, 90%, whatever the number is of exports. And I think there's a vast number of arable land in the country. There is agricultural production happening at the subsistence level. I think agri sector is one key sector to look at that can continue to generate. And again, I talked about ripple effects a long time. So this would not just improve the investment climate in the sector, it will reduce as well food inflation that is very high in the country. Get that, and then you lift people out of poverty, reduce hunger. So I think agriculture is definitely one key sector to look at, particularly because its size in the economy is already big. You just need to make it more commercially viable, right? And make it more investable. And then there are a few other sectors, in gas as well. I mean, I think we've talked about oil a lot, but there is gas that is still relatively untapped. And I think that you can stimulate more investment into that. I mean, the PIA did something around that, but the jury is out on whether the PIA has been effective thus far. We still have subsidies for every other thing. So I think agriculture, I think more in the gas space, and I think there are a few other commodities as well, steel, manufacturing. A lot of these sectors that were dominant, I think back in the 60s, but since we found oil, we've neglected a lot of them. So I think there are a few key sectors that you can get quick wins in, and you probably find investors across the globe that are willing to look at those sectors.
All right, thank you very much. And I think I do agree with you in terms of agriculture being a key sector that should be focused on for good. And I think, it's more or less the general thing. A lot of people talk about that, and I think some of the contestants also in the presidential election next year have continued to mention the important role that focusing on agriculture can play in our economic space. So thank you very much. I think that's a wonderful answer. I think my last question for you before I go on to the question from the audience. And by the way, I think we can still send in our questions into the chat box, and they will be attended to. So my final question for you, I think one of the other things that also stood out for me when you were going through your presentation was your comment around the depreciation we've seen in the parallel market. And I think, yeah.
I was trying to avoid this.
Yeah, I mean, it is a funny one, but I think one thing that we can, and I think a lot of people would agree on, is that the true, or will I say the true rate or the true value of the Naira will be something between what's in the parallel market and the official rate. But I think what we've seen in the last 2 to 3 months has been incredible, particularly in that space. So it's also in a way cuts across, my question now in a way cuts across, the effectiveness of some policies by the CBN. I just want to know what your view is in terms of what's really causing that, very high depreciation we're seeing there. Is it as a result of, supply pressure? Are we seeing some of CBN's policy that's directed towards starving off supply to that market? Are we finally seeing them come into effect? Do you think it's more of a supply pressure because of what CBN has been doing over the last few years? Or do you really think it's just a demand push? Or is it a combination of both? I mean, I just want to have what your view is in terms of what's causing, or what's the major contributory factor to the depreciation we've seen in the parallel market recently?
Can I say all of the above? can I just say all of the above? I mean, see, I would, let me answer the first part of your question. And I think, you said, talking about the fair value of the Naira, right? I mean, I think one thing that is very clear in my mind is that the fair value of the Naira is definitely not 860 or whatever the parallel market rate is. And I think it's far from it, right? Because whatever measure you want to use, whether it's real effective exchange rate or long-term average, or even on a trade-weighted basis, particularly now because, Nigeria is running a current account surplus, right? The fair value of the currency, I think in our minds is somewhere, somewhere between 520 and 550, right? And that's putting a lot of consideration because of the lack of flows that you've seen. When I say flows, portfolio flows, direct investment, because that comes into conversation when you're looking at, this sort of real effective exchange rate. When you want to consider it on that basis as well, and you want to say, okay, let's compare what's inflation differential, interest rate differential between the two countries. Two countries meaning now Nigeria and the US. Inflation is at what, 20%? The US is at what 8% or 9%, whatever it is. So you're talking about an 11, 12% overvaluation, right, of the currency, if you want to look at it in a very simplistic form. So obviously, clearly, it is not 860. But your second part of your question is the clear one, that, what basically has driven it. It's basically the lack of liquidity in the official market, right? When you look at 2017 to 2019, everything was fine. And why was that? There was a lot of liquidity. You had significant foreign portfolio flows that were being funded. The central bank was funding the BDCs, was funding basically every sector of the economy. There was a significant amount of dollars available. But when everything turned in 2020, you had the portfolio flows exit, which were the significant, contributors to sort of the FX flows that we're seeing then. And then, the central bank decided to go towards a more managed approach of the currency in terms of not allowing the currency to reflect the realities of the demand and supply at the time. And then we've been at this stage since. So it then left the central bank as the major provider of FX liquidity in the market. And the central bank here as well is trying to manage its reserves, right? And its reserves are facing a lot of impediments, i.e. low oil production, significant drop in oil revenues from oil subsidies and a number of that. So you're not seeing the natural accretion you could have seen from the commodity price shock on the external reserves. And that's a fundamental problem. So the central bank, again, is mindful of managing the reserves, and you can probably continue to see a lot more swaps that's been done to be able to generate USD. So there is no liquidity, right, in the official market. And obviously, there is still key sectors in the economy that are FX dependent, and they need to get the liquidity from somewhere. Whether it's you wanting to travel for your PTA or your invisibles, whether it's corporates or SMEs that are looking to import a few goods here and there, there is still the demand for the dollars. And you cannot take out the activities of speculators as well. I mean, there would always be speculators, given that you're in a situation where everyone thinks that the currency will consistently depreciate. So all of these factors have contributed to people looking for liquidity elsewhere, and that elsewhere is the parallel market. I mean, the central bank continues to say, this market is not legal, to the the quantum of supply there, or the quantum of transactions happening there is low. But I think that there is a virtual parallel market these days where I understand that, it's transfer market, right? A lot of people are doing transfers, and those rates are reflected in the parallel market as well. So I think that is the concern. I think if you are able to get back to a situation where there would be ample liquidity in the official market, i.e. in FX, and that can happen in a number of ways. One, the central bank allows the currency to first initially float, allow it to depreciate, finds a level, and then that then stimulates flows back into the official sector. Because the truth is, you probably find people that naturally would have sold into the official market, perhaps go to the parallel market, right? I mean, why would you want to sell your rate at 440, your dollars at 440 when you can sell at 860, for instance? So all of those dynamics will come to play. But obviously, if there is no FX reform in terms of whether allowing meaningful depreciation, or the central bank decides, okay, I want to spend my reserves, and throws $10 billion at the problem in a space of 2 months, for instance. I mean, it's probably not going to do that. But I'm just saying, if it decides that. But something needs to happen that would bring liquidity back into the official market. And then you would see the rate in the parallel market collapse if people are able to get offshore. And people start to get the sense that there is a sustainability in the flow of what you're seeing in the official market.
All right. Thank you. Thank you very much. And I think you are quite right. You're very right, actually, in terms of whatever is happening in the official market, somehow, even if it not directly, feeds through to through the parallel market. And if we eventually see a lot more of supply there, it will definitely somehow affect sentiment in the parallel market. I do agree with you 100%. So thank you very much once again. I think I'll just take a few more questions from the audience. I think we have about 3 questions already. I'll just take 1 or 2 from the audience before we round. I think we've taken quite a lot of time, but even you have to agree that the conversation around macros is quite deep, and I think we're doing justice to the time. So I think the first question I'd like you to ask, I think to answer to, is from Folusho Showande, and I think what she's asking is what you think would be a most effective strategy that can be put in place to tackle food inflation. I know you mentioned some things about much more investment in agriculture, but at least I'd like you to touch on some of the other key points that we know are causing some of the effects of food inflation. For instance, the issues around transportations, I mean, from moving food produce from the north, where you have most of the farms, down to the south, where you have quite a lot of supply, and also things surrounding insecurities and all that. So I know investments in agriculture has been touched on a lot, but what do you think in terms of the other factors that contribute to food inflation? So what do you think can be done to tackle those other factors?
Yeah, thanks. I mean, I think you've mentioned some of the things for me, insecurity, infrastructure. I mean, how do you tackle insecurity, right? You just need to hope that the authorities have the best interest of the country and the people at heart, and have genuine intentions to solve the issues, right? But obviously, I think the first point of call to tackle the high food inflation is, Nigeria doesn't produce enough food for its population, right? And which is where the conversation around the investment comes in. It is still seen as largely subsistence, and it's not commercial, right? There are a lot of arable land, we talk about it. I mean, food importation is still a pressure on the import side, and that feeds through to inflation as well. Because when you have a currency that continues to depreciate, of course, the price of imports for food will continue to go higher. And that's one. That's on the import side. That's food import. So, I mean, how do you tackle that is to be able to produce more locally. And for you to be able to produce more locally, you just don't want to be able to produce more locally. You want to be able to produce more locally and as well as export as well. I mean, Nigeria can literally Nigeria is very competitive in production of, things like maize, for instance, right? Or that's rice that we want to produce, or a few of those things. But I think that, we still import a lot of our rice, and you still see a lot of that happening. So clearly, investments need to go into that. And I think we need to, again, give credence to climate change. And climate change is not just happening everywhere. It's not just happening in Nigeria, where you've seen it happen everywhere. Climate change is, drought in Kenya, flooding in some other parts of the country. So it's not just, putting money into commercializing agriculture, as it were. You need to be able to mitigate against climate change factors. So whilst you're investing in that big farm or in that big farm, you need to put in proper irrigation that will be able to, ensure that, when this climate change impact comes, you're not affected and your production is not significantly affected, and able to mitigate such factors. And then, of course, is to be able to create the right infrastructure, that will be able to transport things around. And one of the ways to do that is, of course, one, provide the infrastructure, but second, to have regional hubs for production of some key items. I mean, I'm sure there are different parts of the country that have competitive advantage, if you like, in production of some key agricultural products. You probably want to look at different regional hubs across the country, so that at least whilst the guy is trying to transport whatever it is transported from the north, the guy in maybe Edo or whatever, he'll be able to transport that to closer regions. So again, is basically just having some form of domestic reforms targeted at these sectors, and I think all of the things we have talked about here would help.
All right. Thank you very much. That's I think you hit the nail on the head in terms of what needs to be done. So I think the second question I'll be taking from the audience is from Brian Ailes. He says that FX liquidity remains a major concern for investors. I think we can both agree about that. They cannot repatriate their funds, and thus uncertainty reduces incoming investment. However, the reserves could clear the backlog and the pending queues. The CBN is also not being forthcoming with information about their intentions in this regard, in terms of clearing the backlog of demand. What do you think? Do you think that this could change before the next elections?
Too much. Did you invite the governor to this thing? So, I mean, do I think that it's going to change before the elections? I mean, my clear answer to that is going to be no. And the reason I say that is I don't see why it will change before the elections. Because, I mean, what is the change going to bring in this instance? First, I think it is clear with how the central bank has managed reserves in the past few years that reserve accretion and keeping reserves at a decently high level is priority. And anytime reserves tend to start to decline more significantly, they come with these controls. And so I think that much is clear. And I think, it is in the interest of the central bank to keep reserves at what they consider as adequate levels. I mean, I don't know what that number is, but, it's obviously, not somewhere below 35 or 33 or whatever. It's obviously decently high. So I don't see what's going to prompt a change in terms of, either the central bank trying to immediately clear the backlog or, supply the market. I think another thing we need to consider, and it's a question the clients ask a lot, is what can we actually estimate as net reserves for the country? Basically, how much of that do you think is actually liquid reserves that can actually be used? And one way we try to think about this, before now, we think about, okay, so what's the level of foreign portfolio investment that is still left in the country that could potentially go out within the next year? Basically look at the short-term external debt or external obligations that the government or the central bank could have over the next year and try to back that out, and then add on top of that, what do we think the swaps with the commercial banks have been? I mean, if I put all of that together, all of those variables together, I think you're probably somewhere, numbers probably add up somewhere around 20 billion max in my mind. Because I think the net swaps, when I did the calculation, and there's data for this published as well, the net swaps came to around something around $15 billion at the end of June. So then you're looking at those short-term maturities and those short-term obligations that could potentially come due. And of course, CBN has that at the back of its mind in considering that. So I don't think anything, at least, I don't think anything changes materially, clearly before the elections, because the central bank continues to hit the nail that this is Nigeria. Nigeria will be managed. It's a managed float regime. They'll continue to manage the reserves as they see fit, because it's Nigeria. Nigeria has its own idiosyncratic factors and should be managed accordingly. It can be compared Nigeria to maybe other EM markets or other developed markets. So I clearly don't see a change in behavior here, particularly not before the elections. After the elections, maybe, who knows? I can't comment on that. I think you're on mute.
Oh, my bad. Apologies. Thank you very much. I think one final question before we call it a day on macros today is there's a question from Olu from PNB, and it says that agriculture is key, but so is infrastructure, especially from a transport perspective. If we can get tourism sector moving forward, this will help tremendously. But this can only take off with proper infrastructure in place. Why is the country unable to see the benefits of this? So I guess it's more or less of an open-ended question, but I think, I mean, if you want to take a...
No, I can comment. I agree. Infrastructure is key. I guess we talked about it as regards food, and I think within the context of the Africa Continental Free Trade Agreement, if Nigeria eventually, becomes a productive economy like everyone would hope they will, then you need critical infrastructure. I think one thing we haven't talked about at all as well is power, right? Energy. And I think that's a critical engine for growth and development in the economy. If we are going to talk about Nigeria having a lot of productive sectors and contributing more, particularly in the non-oil sector, to exports, then you need to fix the power, you need to fix the infrastructure. So I think that no, I completely agree. I mean, tourism. I think I don't know that any of the guys in authorities are really thinking about tourism in any significant manner. But I agree with infrastructure.
All right. Thank you very much. I think it's been quite an interesting conversation. I've learned a lot. I've heard a lot, and I think I do agree with you, particularly on your point regarding monetary policy and where you think things will go globally and how that might affect us in the next coming months leading up to the election. So once again, thank you very much for your time, for your presentation, and for the responses you gave to our questions. Thank you. So
thank you very much, and apologies for my lack of tech savviness in moving through this presentation. But thank you for the time.
You're welcome.
Thank you so much, Bola and Taiwo, for that session. We will be heading quickly to the agenda, and we will be taking, in the interest of time, we'll be taking the DG-DMO subsequently, but based on our schedule and timing, we'll be having a chinwag with the Chief Executive Officer of FMDQ Group PLC, Mr. Bola Onodele Koko. He's the CEO of the FMDQ Group, a financial market infrastructure group covering exchange, the central counterparty, depository, and of course, private markets. Before this role, he was president of FDHL, a financial markets and risk management consulting firm, which he founded in 2001. Koko is seen as being a banker of bankers. He's trained many bankers within the industry at executive level, and he's very passionate about teaching. He's also a member of the Board of Trustees of Financial Market Dealers Association, and is an advocate of gender equality, especially in the workplace, and with girl-child education. So he will be joining us. We do appreciate having you, sir, on the call today. Joining him will be our dear Aderonke from Citibank. She would be the rapporteur for this session, but we yield the floor to Mr. Bola Onodele Koko. Thank you very much, sir.
Thank you very much, Babatunde. When you say you yield the floor, what do you expect me to do? And thank you for the introduction. Aderonke, are you going to guide me? How many minutes do you want me to speak for before you come in to do the moderation, or what is the style?
Yes, I think you can start 15 minutes, but we have a bit of time on our side. So I think you can go on as long as you want, maybe keeping it to a max of 30.
Okay, thank you very much, and good afternoon, distinguished guest on the call. I think the topic you had wanted me to speak to likely is about derivatives, and you wanted to know how Nigeria has been prepared for this derivatives market, and really what are the upsides if Nigeria is able to get this right. And the reason why I said that is we've had a situation in Africa where the derivatives market has not really panned out. And it's good for us to learn through that. The issue of derivatives, as we all know, most of us see it as risk management, and it's very ideal in any financial markets, not just Nigerian financial markets. And if you look at the history of derivatives, you will actually situate that with agricultural products. And it was very important then, we're talking of centuries now, for farmers and buyers of the produce to have some financial stability for the agricultural products. So financial derivatives actually just came on in the 70s on the back of the sort of volatility that the world started to see in foreign exchange and later interest rate volatility, because of the sort of liberalization and deregulation that came up in the finance world. Fast forwarding to 2007, the world had built on OTC derivatives, and we've all now understood the OTC part of derivatives and the exchange traded part of derivatives. And then we witnessed the global financial crisis. And the general talk, everyone complained about derivatives causing the crisis. But it's good to mention that the stress came through the OTC derivatives and not the exchange traded derivatives. Indeed, during that period, there was almost no failure for the exchange traded derivatives. But the OTC derivatives had issues because there were no standards as to how OTC derivatives operated. What the world then did, the Financial Stability Board, took the position that OTC derivatives have to be cleared. There should be more transparency with OTC derivatives, and there should also be some form of structured processing with derivatives. And when they use OTC largely abroad, they're speaking to OTC derivatives. And that period, in trying to solve the problem and ensure there's not, to forestall a reoccurrence, the world, the FSB advised and introduced a new infrastructure to the world, and that was trade repository. So in essence, OTC derivatives needed to be submitted and tracked and reported to an infrastructure, so there are records of it, because the lessons from global financial crisis show that things were not well recorded and tracked. So the preparation for Nigeria, really, the work we've been doing for some years, it's been around the introduction of exchange traded derivatives, just to ensure that we build a market that is going to be resilient and also going to be sustainable. Nothing would take away OTC derivatives. The market, banks, and their clients will still have the need for bespoke structures to provide risk management solutions to their challenges. So we need to put that in context. But this new market is the exchange traded derivatives. So the two are going to operate side by side. You're going to have the OTC derivatives, and you're going to have the exchange traded derivatives. And we believe that we know that the Securities and Exchange Commission has also put things in place to ensure that the OTC derivatives will continue to grow, and the exchange traded derivatives market will start. Indeed, in the international market, the OTC derivatives always trade in multiples in terms of turnover and everything, market value-wise, multiples multiples of the exchange traded derivatives because clients will require bespoke structures to take care of their challenges, which the standardization in the exchange traded derivatives may not take care of. So from like the multiples of 5, the OTC relationship with ETD has sort of globally dropped to about 2 in terms of market value. In Africa, I think there's only one successful market, and that is the South African derivatives market. Kenya tried the derivatives market, and the success there is limited. And Nigeria has also joined, and it is good for us to really speak to what the success factors were for South Africa and what happened in Kenya. So Nigeria can learn from this, and I hope we will. If you look at South Africa, I think there was some philosophy which Nigeria is still struggling with. How really do you want to run your market? Are you going to accept that prices and rates can move and change? And then these risk management products, which is the way we see derivatives. Some people get excited with what Warren Buffett said about derivatives being weapons of mass destruction, but they may want to look at his company and see the size of derivatives that company applies in managing risk. He was speaking to the OTC market and the way it was done. He wasn't speaking to the exchange traded markets. So South Africa must have adopted a philosophy that markets change, markets will go up and markets will come down. And when you start with that philosophy and understanding, it will help you to understand that derivatives are the risk management products to provide the sort of stability, financial stability that may be required. So the success for South Africa came from the agricultural sector that had to be deregulated. And once you deregulate any sector, you get the sense that there'll be factors that will cause movement in prices. And what you need actually is to ensure that you have derivatives. If Nigeria someday is going to look at deregulating its foreign exchange market and so many things again, Nigeria must take interest to have derivatives market, to take care of market players who may be worried as to volatility that they see in the market. They also had exchange rate reform. So the agricultural side promoted the agri derivatives, the currency deregulation cost, the exchange control reforms led to currency derivatives. They also had capital market growth, which promoted the equities, and the economic growth also promoted interest rates, because once you also have a deregulated interest rate regime, you need to have derivatives in place. You know, one thing that helps emerging markets and frontier markets to develop is the presence of foreign players in the market, whether the players are part of the traders or they're investors. What South Africa has done very well is to sort of encourage, to sort of build an international market from beginning. So in terms of ease of doing business, that was highly promoted. And if you compare this with Kenya, you wouldn't find some of the things I'm talking about. So for the derivatives, you need that underlying market to be robust, to be liquid. And also volatility will come if you adopt market principles. And that would underscore the need for you to have risk management products, which is what we see derivatives as. So those were the factors we saw in South Africa. And we hope Nigeria will, take the same, adopt the same approach in building this economy, this great economy, if we can adopt those principles, ensure, you put things in place. Kenya suffered, has experienced limited success for so many reasons. Capacity is also one of it, because when you launch equity derivatives and the players in the equity market do not have the capacity, then that could also be the reason, one of the reasons why your success may be limited. So first is the capacity in taking positions in the spot market, and then the capacity to commit capital and risk management competence to the franchise for a derivatives market. So if you look at Nigeria, are we ripe for this? It's taking years for us to get to this point. So if you ask me, I would say Nigeria has been trying to build this derivatives market, but all the stakeholders appear to have taken the position that the time is timely to launch the derivatives market. Leading this charge is the Securities and Exchange Commission, who's done a lot of work with his rules and regulation. But, you know, this whole derivatives market and the value chain would have to rest on some legal framework. And CAMA, the Companies and Allied Matters Act 2020, helped in putting the foundation for a derivatives market, because the provisions in that law that sort of provided the critical pillars for operating a CCP, which will support a derivatives market. So that legal foundation was there, and then the regulator, the SEC, has done a lot of work on the regulation. Also the buffer, because the role of the banks cannot be overemphasized when it comes to liquidity and, you know, the competence required, the capacity required. The buffer has also had provisions to support netting and bankruptcy remoteness, all the things we found in CAMA. So it's now going to be possible to net. It's now going to be possible for these financial contracts to be novated. And also the collaterals that are kept to the clearinghouse also have bankruptcy remoteness. So that no liquidator can ask for those collaterals. They have to support the financial contracts. So if you look at the Nigerian situation, the exchange has also done a lot of work, and also the clearinghouse putting all their own rules in place and carefully onboarding the members, and also going through the systems and all the work that are required. So the FMDQ Exchange and the FMDQ Clear, which is the clearinghouse, the CCP, they're doing all necessary and dotting the I's and crossing the T's to be sure that when the market starts, operationally, there'll be no challenge. If you look at the market, because at the end of the day, if you have infrastructure and you have willing members to trade, you then need to look at the market itself. So let's look at these market factors. Interest rate, I think we're beginning to see a rise in interest rates. The market appears to be deregulated when it comes to interest rate. The currency side is where things are still challenging, but Nigeria travels through this route from time to time. We sort of have a market that shows less liquidity, and at some point you have liquidity coming on the back of the policies. And we think the orthodox ways are going to come back to the Nigerian market. If you look at the equity market, the economy is struggling, so you expect the equity markets to reflect that. And you have some measure of volatility. The index has been up this year and is starting to trend downwards. So the Nigerian financial markets have the bubbles and the volatilities from time to time that, you know, any player in the market that is not a speculator will think about buying these derivatives products to sort of create the financial stability required in their businesses When I worry most about Nigeria, I start from the government itself that operates and funds its expenditure mostly from crude oil earnings. And that product is one of the most volatile products as known in the financial markets. So if you start talking about preparation of Nigeria for derivatives market, we need to think of the players in the country, and we also need to think of Nigeria itself. Nigeria itself will need to start thinking of risk management products in managing the finances. And I think that will be a case for finance ministers to look at when you find the crude oil price very close to three digits. What should you do? Isn't it time to think of buying some put options? So when the prices go down, you can still sell at a high price. And if the prices rise higher, the beauty of options is you can then still enjoy the upside in the spot market. So all of us in the country at the moment need to think of this risk management product. So I've talked about Nigeria. And if Nigeria is doing that, I will expect the subnationals to also do that. So if you are thinking of FARC, this is where you have crude earnings being converted into Naira. And if the exchange rate is not fixed, then you should expect that the Commissioner of Finance of a state can actually also see some volatility in the FARC revenues. And that is a case for risk management as well. Now for the corporates, we know the volatility in exchange rate and interest rates are things for them, things that they worry about. But with derivative products, you can focus on your businesses and you can buy all your derivatives for tenors longer than 1 year and up to 1 year to ensure that when you're doing your budgets, you have some stability as to that. This will be very important. If you ask people on this call now what rate they're using for their budgeting for 2023, you're going to get different answers. The way to play in the market is not to be guessing or forecasting or praying or fasting. What you have to do is to go to the market and buy futures. And once you have the futures, you have the prices for which and the factors you use for your budget. Even the banks, you worry about asset liability management with the way interest rates move from time to time. Over the years, whilst I was still in banking, I used to tell my colleagues that their hands were actually tied in managing the balance sheet, because even if you have the view that interest rate will rise, there was really nothing you can do to protect yourself. The best you would do is probably to rush to some depositors to fix their deposits for a much longer period. But these depositors do listen and read the same research that you've read. So why would they do that if they have the view that interest rates will rise? They too want to keep their deposits short so they can enjoy the higher interest rates. So this is going to be an opportunity for the banks to start asset liability management, which is a very decent discipline, an interesting one which has not been practiced in the market before. People can tell you about balance sheet management, but no one has really done asset and liability management in the quality and the competence we're talking about. Now, all of us on this call, if we're Nigerians, need to worry about pensions. I'm closer to cashing out, but there could be some much younger people that need to worry, because if indeed your contributed pensions are being invested in T-bills or have been invested in T-bills or bonds at single digits and yields are now going up, you need to be worried. Inflation is trending at the 20 levels. You need to be worried. Equity prices are dropping. It means that really the capital you're contributing today, in future, by the time you're getting paid, the value will be extremely low. But the pension fund administrators know that they're going to be receiving your cash ahead. So if indeed they know that your cash is going to come to them and they think, I'll take the view that interest rates are likely going to drop over time, this product is also for them to use and buy such that, when yields drop, your own yields for your portfolio, they will have bought at prices today that will ensure that you get good value. So individuals, all of us as individuals, businesses, and the entity, the corporate entity itself called Nigerian PLC, will need to think seriously about derivatives. And those managing either our pensions or those that are corporate treasurers or those that are managing the affairs of Nigeria at the national level would need to focus and understand how they can deploy these derivatives. I think I already spoke to the regulatory framework. Part of the work the SEC is also doing is pushing ahead the investment and securities bill 2021, and if they're able to achieve this as hopefully before this assembly goes, they also have provisions for multilateral netting and things like that, which will help. In terms of the required financial market infrastructure, as I said, FMDQ Exchange has done all the work necessary. FMDQ Clear has capitalized itself, apart from the regulatory capital of 5 billion, has also built a default resolution fund, and the plan is to build that to significant levels, probably in 6 or 5 multiples of the regulatory capital, to give confidence to all the players, especially offshore players, that resolution default can be addressed. One area we still need to discuss with the regulator is how to avoid a lack of liquidity. And I say that because when the market starts, it's typical to find people most times having the same view of the market direction. It is so critical when you're going to build liquidity to have speculators in the market. And speculators are people that are willing to put some of their capital to ensure the market is functioning and is going to provide opportunities for those that want to hedge. Because if all the banks start, all our members start to trade and everybody wants to sell and nobody's buying, there will be no trades done in the market. So the views, the education of counterparties, we must have people that want to hedge a rise, people that want to hedge a drop. That will create some activity. But you also need capacities of institutions that have played in the derivatives market over the years. And they have capital they can commit, which will probably be much bigger than the capital that we, as we're starting, can commit. And that's why we have also been talking to the regulator to allow us on board some offshore banks and players who already are regulated by entities offshore and belong to the same club of regulators. And we need this when we start our market. We've seen what the exit of foreign portfolio investors did to the FX market. It's going to be the same thing if we keep these people out as traders in the derivatives market. We think we need them to build the initial liquidity and also to give time for knowledge transfer between the derivatives members of the exchange as we develop this market. In terms of readiness, I'll say we are close to it. But there's one thing that wouldn't stop, and that is going to be education. We need to get a lot of the clients who have been used over the years. They've been used to absorbing risk that they see in their business, and that's how they've done business. Pension fund administrators, insurance companies, corporates that are borrowing, banks. Over the years, since Nigerian financial market started, people have just been absorbing this risk. So we need a lot of sensitization and education work to get this message to people, to appreciate the risk in their business and to appreciate now that there are products that can cure this, and to trust the members of the exchange. Also, what we've done is to elegantly hope we'll build a market, an integrated market where you have banks and investment banking institutions that will be derivatives trading members of FMDQ Exchange from day one. We've seen the importance of that integration. And the messaging, the sensitization and education is not going to be limited to FMDQ Academy alone, but also for all the trading members to get involved and educate their clients. And we've always said that where banks want to, or derivative trading members, really, whether a bank or an investment banking firm, where they desire to speak to their clients, FMDQ Academy will be willing to support them in sharing the understanding of the products and also the risk and of the products, and how the products can then be used to hedge. If you look at the, I think the other side is the upside. What are the upsides we see if we can build a liquid derivatives market? Definitely, I listened to my friend, the last speaker. We believe that the Nigerian exchange market will change. We believe that we'll see foreign capital inflows into the country again. Is one of the sources of foreign inflows into any country. So we're going to get that again. We believe when we have this, we've seen how they use the existing OTC futures that are in place. I think that has been built, over $62 billion of it executed on the platform. If we return to this type of business, managing our short-term challenges with some short-term solutions, we will definitely need some stability in the exchange rate. So this currency derivatives will be very useful to address this sort of volatility that market will witness. It will promote market liquidity and depth for our market. Again, it will impact anyway on financial system stability, because there's a very thin line between financial markets and financial system stability. You can just imagine if today the exchange rate moves and the central bank applies in its banking supervision principles for banks to mark their portfolio to their balance sheets to market. What happens in the bank's balance sheet is that whereas your assets would have to be repriced, the capital itself has been converted to Naira. It doesn't get repriced to the new exchange rate levels, and then you start having capital adequacy challenges. So banks need to prepare for this sort of actions that may come from the regulator. So in a nutshell, we believe Nigeria, the regulators, the financial market infrastructure, FMDQ Exchange, FMDQ Clearinghouse, the banks, the non-banks that are signed on to be members are ready to kickstart this market. The market has also received the blessing and the no objection from the central bank, the debt management office. The SEC has approved some entities to act as clearing members and is still working with the Capital Market Institute to get some of them approved. So I think all the work we need to do, we're doing, and we're hopeful that the markets will launch soon. But I always separate the launch of the market from the success of the market. And I think on the success side of things, this is where we need to throw in some flexibility to ensure that we take on the South African market to start chasing them in terms of positioning, rather than us going to share similar experience with Kenya. Thank you, Aderonke. Thank you all for listening.
Thank you very much, Mr. Onodele. Thank you for taking us through the history, how Derivatives started and bringing it back to our context, Nigeria, what we can learn from South Africa's successful path, what we can avoid looking at the Kenya example. And hello to everyone. Thank you so much for investing your time with us this Thursday and staying with us till afternoon. Before we dive into questions with Mr. Onodele, would like to shake things up a bit and take the temperature of the room, especially because Mr. Onodele is here to talk derivatives, but he's also FMDQ Group, which is a financial market infrastructure giant. They have an exchange, CCP, depository business, and he's an FX expert. So if you please go to the chat box, you'll see we've provided a link there to menti.com. There are a couple of questions for a poll, just 2 questions. So please kindly go there and respond, give us your opinion. A question was asked to the previous speaker, Gbolahan, about when he thought the FX liquidity issues would be resolved. Would they be resolved before the elections, which is in 3 months' time? He said no. So let's know what other people think. And if you're having any trouble clicking on the link, if you just go to menti.com, that's MENTI.com. The code is in the chat box as well. It's 4889-8273. The questions are there. The first question is, when do you think FX liquidity will return to the Nigerian market? So is it within 3 months, within 6 months, or will we still be in the same position this time 2023? That's the first question. And the second one says, what issues are top of mind for you? So whether you're a global custodian, you're a local fund manager, an insurance company, a broker dealer, or you're even an investing client, what are the issues that concern you or that you're thinking about when you consider holding assets in Nigeria? Is it FX? Is it the length of the settlement cycle? Is it asset numbering, ISIN? Is it corporate action? So just to keep it short, we'll give you about 20 to 30 seconds to quickly answer those. And then the team will just bring up the results for us. That's just to break the ice a bit. While we're doing that, please do raise your hand if you have any questions for Mr. Onodele. And if you prefer, you could also send us a question through the chat box. Let's just quickly answer those questions. 10 more seconds. Going to assume everybody is done now, unless you indicate otherwise. So this is a very interactive session. Please feel free to use the reaction buttons. Thumbs up if you're done. Thumbs up, thumbs down if you're not done yet. Would like us to wait for you. Okay, so I think we can close the poll now. Can we display the results? How many people think this FX problem will be resolved before the elections or within 6 months or within a year? And what are the issues that are critical that people are thinking about? Can we have the results displayed, please? Thank you. Okay, so while we wait for that and, just checking to see if anyone has their hand up or has any questions for us, I'll just maybe dig into mine. So our goal today really is that for whatever anyone's role is in the industry, that when they leave our ASCN session today, they come away with something, a new idea or a fresh perspective or a new strategy about how they're going to be successful in managing their assets and business in Nigeria. And to start us off, Mr. Onodele, in your long and successful career in the banking sector, you would have seen several FX crises over the decades. And even in the last FX crisis, which ended in 2017, the FMDQ was instrumental in the development of the OTC FX futures, which are the Naira denominated non-deliverable forwards. And that was quite instrumental into resolving the crisis and bringing in liquidity into the economy again. So our first question is, what role will FMDQ be playing in the current resolution of this FX crisis?
Thank you, Aderonke. The crisis is not, what we have now is not dissimilar to what we had in 2017, 16, 17, actually. And the template is still there. The only role FMDQ has today is advocacy, to keep engaging the relevant stakeholders for us to sort of do the right thing. And the right thing today, it appears, will be for us to open the market. And in opening that market, we'll find a measured way of doing it such that liquidity returns and the economy starts working again. It's gotten to what I call Tina. There's no alternative. We've tried what we have now. We're all struggling, and we can see the stress is a lot. So that advocacy will continue. Again, it wasn't a silver bullet in 2016. It was the same engagement. And I think the relevant authorities, and I must mention that engagement, and when I speak to relevant authorities, it's not just monetary authorities, and for people to appreciate that the monetary authorities also help and support the engagement at the level I'm talking about. And that is how it's going to work and it's going to get resolved. In any economy, there'll be battle of ideas, and people in government would have, you have different views. Even in monetary policy committees, you have what you call the doves and the hawks. It's just the way life is. And it's just about us listening to the other party, and assessing whatever approach we've taken, and then being ready and open-minded to consider and adopt another approach. I think we'll continue with that advocacy. And it's not only one party doing it, there's so many parties in the market helping to resolve this. But it appears we're due for a change. This approach is challenging.
Thank you, Mr. Onodele. So it's a combination of monetary and fiscal authorities, the political side as well as the economic side. Thank you. We have a question from the audience in the chat box. I'll just read it. It's about the younger generation. You spoke earlier about pension fund assets and hedging and protecting, and about how you are nearer to cashing out. We have a few young people, so the younger generation, they're interested in capital market investments, but it's reducing because their interest in blockchain is on the rise. Tokenized shares have been a global discussion, and so on and so forth. So do you, as the FMDQ, plan to use blockchain in the future? And if you do, in what capacity?
Thank you. We will in the future. I mean, we have no choice. Capacity will be, you cannot but offer what market has interest in. And we have seen what the other exchanges are doing internationally. Nigeria is going to play catch up on this because of where we are at the moment. So our immediate priority is actually, Nigeria does not have a repo market to the standard, global standard. We need to fix that. We need to fix this derivatives market so everyone can manage risk. We already set up some much younger people in our exchange as well, looking at these products of the future and where things are going. I mean, we call it of the future, but they're already there internationally. So there's a project team that's been put together. They're brainstorming and looking for what we have to do and thinking through all those. And I'm sure that project will probably come on stream by next year and for us to start working on it. So blockchain, DFI, tokenization, crypto, are all the things that I believe that team being led by one of my colleagues is already looking at. I'll be making the presentation to management next year. That's the sort of institution we're in. But we also believe in fixing problems of today as well. And these challenges are very important and critical.
Okay, thank you. So no one has asked this question from the audience, but it's a question that we've got from our clients, and I'm sure it's on a few people's minds. It's about the duplicity of CCPs in Nigeria. So like you've mentioned, derivatives market, it's in its infancy. We're just starting off. And some people ask, is there really a case for 2 CCPs? Would you like to speak to that?
If you give me an option to answer your question, would you like to speak to that? I'll say no.
Would you speak to that, please, Mr. Onodele?
But I'll speak to it, and it's good for us to understand the context. And if you look at the size of the Nigerian market, or you look at the size of the derivatives market, you don't even have any market. So you wouldn't expect that you will be flagging up with 2 CCPs. But it's not unknown to, and I spoke to Battle of Ideas earlier, it's not unknown to people that understand our market, that we have the FMDQ group and we have the NGX group. And we sort of didn't agree on how the market should run. As you're aware, the NGX has launched its derivatives market. We have not launched. We're still working. We have differences on how things should work. But, you know, that multiplicity you see today, or well, that duplicity you see today, at times is very good for both of us to get entrepreneurial as we start, because you never know who's going to be right. And later, I believe that, which has happened in many markets, Europe and everywhere, there'll be some consolidation of efforts, because clients that have derivative contracts on the 2 clearinghouses are going to be looking for some portfolio benefit. So I think it's good that we didn't destroy the intellectual and entrepreneurial energies in the 2 houses. It's good to let both start the way they see things. The perspectives appear to have been different. And later, I'm sure the market will grow, and that evolution could cause consolidation. So I don't think it's anything for players to worry on yet. The market has not even started. Let's start it. Let's see how it works. And then we'll do the right thing. But I have no doubts in my mind that medium term, long term, the market will see a single infrastructure.
Thank you very much, Mr. Onodele. Thank you for sharing your thoughts and your insights on the derivative market with us today, and for spending time with us. I'd hand over the mic back to Tunde. Thank you, sir.
Thank you very much, Aderonke. Always good to see you and work with you.
Thank you again, Mr. Onodele, and thank you, Aderonke. Like I said, when we started the session, I expected that we'll go much into teaching, and I think you did justice to the subject, and we are so grateful to have you join us.
Thank you for having me.
Thank you, sir. We'll run right straight into the agenda, given the interest of time. We have also present here one of the key financial market infrastructure, the NGX, and ably representing the NGX is the divisional head, capital market, Mr. Jude Onyeka Chiemeka. Mr. Jude has well over 30 years experience within the capital market, and he has done amazing working within the working as an operator before working now as a financial market infrastructure. He was at some point the MD CEO of United Capital Securities and championed quite a lot of initiatives within the West African corridor. And he's joining us today to share a view around the demutualization of the exchange and the questions around the benefits of the new structure, as well as the market and product development that we expect to see from the exchange going forward. Joining him in the conversation will be Ademilola Aluko from Stanbic IBTC. Mr. Jude, apologies for cutting your time short, but again, we're giving you ample time to share your thoughts this afternoon with the audience. The virtual lectern is yours, as well as Ademilola's. Thank you, sir.
Thank you so much, T-Match, and thank you so much, Mr. Jude, for joining us. So just to delve right into the crux of the discussion, the exchange has now completed its demutualization process, joining the league of the Johannesburg Stock Exchange and the Nairobi Stock Exchange. Can you take us through the benefits of this demutualization to the market and to product development?
All right, thank you, and good afternoon, distinguished ladies and gentlemen, and First, let me start by thanking the Association of Asset Custodians of Nigeria for inviting us to this your conference. It's very timely as always, and we were truly grateful to be sharing our thoughts here. And so just speaking on the subject of demutualization, for those that don't even understand what that means, just in simple terms, it's a process of conversion of a mutual entity, such as the exchange, the Nigerian Stock Exchange in the past, from a mutual holding structure and converting it legally now to a shareholding structure. So whereas it was owned in the past by daily member firms and ordinary members, it's now owned by shareholders. That's the simplicity of demutualization. So it's not a private company owned by shareholders. And the exchange, like you pointed out, is not alone. The whole process of demutualization started globally since 1993, where Stockholm Stock Exchange became demutualized. And we've seen a lot of exchanges following that path. As a matter of fact, Nigeria is 57th member that has gone through that process out of the 70-member World Federation of Exchanges that we belong to. So for Nigeria, what does that really mean? It means that the Nigerian Stock Exchange, like we knew in the past, has now metamorphosed into a Nigerian exchange group. And that group now has 3 subsidiaries. You have the Nigerian Exchange Limited, NGX, that's the operating exchange that houses both the trading and the listing business. And you now have the Nigerian Regulation Limited, which is the independent regulation company. And lastly, you have the NGX Real Estate Limited, which is the real estate company that houses all the real estate attributes of the exchange or businesses of the exchange. The structure clearly has positioned the exchange to be more competitive, not just locally, but also internationally, and to be able to take advantage of emerging trends as the Holdco company is non-operating and will continue to have investments in key strategic companies across its objectives. What are the benefits of demutualization? Several. Clearly, as you transition from a mutually owned entity, you become private, and now so it imposes on you to make profit for your shareholders. So the rate of accountability heightens competition or competitiveness of the exchange. So the exchange has become a lot more profit-oriented and very focused, nimble, and it can compete locally as well as internationally. There's also the investor base itself. So the current shareholding structure from the mutual entity, where the daily members as well as the honorary members have transitioned into shareholders, and ultimately the exchange is listed, and that exposes it to other shareholders as liquidity is now created commercially for the existing shareholders. We now have more shareholder participation, which creates more opportunities for the exchange as well as the shareholders who are now investing. There's improved corporate governance with independent regulation company out of the way, a separate board, a separate structure. The market is regulated in a manner that enhances the right corporate governance across all the various segments of the market. And there's the element of product development, which you clearly pointed out. And this has led exchange to become more commercially driven in order to satisfy the needs of the growing customer base. So today we have launched our exchange traded derivatives, the first in West Africa. And the back of that, obviously, the functionality that the derivatives provides to the market, I believe, holds no limits, because now you have a complete market. Investors can de-risk their portfolios. So all the sharp volatilities that we used to see in the past can now be moderated by investors taking advantage of this product. But there are a lot more products that exchange is working on. Key is really transitioning from the regular exchange, where you have the average age of about 55, to creating products that the millennials and Gen Zs will find a lot more interested in. So we're transitioning into a digital exchange So we're talking about tokenization, creating a pathway, digital pathway that will allow seamless onboarding. We have 49 shareholder or 49 million individuals that have BVN. And if you look at the universe of investors that play in the market, it's about 3 to 4 million. And so that there's a huge gap that needs to be filled. And part of the problem is really the onboarding process, the KYC process. And what we're doing is using technology to simplify that. And we did see that in the first public IPO that was done last year by MTN, just using digital technology, we're able to complete that process in a very short period of time. But beyond that, we recorded additional 155,000 new shareholders or investors who've never invested in the market just because of the advantage of technology. So I can go on and on about the strategic advantages of demutualization, but I think it's a good thing, and it will continue to help this change to be more relevant, to be more competitive, as it continues to provide a platform for issuers as well as for investors.
Thank you so much, Mr. Jude. It seems like interesting times at the NGX. And one of those initiatives that I wanted to touch on during our chat is the African Linkage Exchange Project. I know that the NGX is one of the 7 exchanges that is pioneering this. So can you just quickly advise us on what it entails and the benefits that it will bring to the Nigerian capital market?
All right, thank you. So if you look at the African markets, even if you're looking at it from a population perspective, 1 billion, 1.2 billion, but then you have all this segmentation. So Nigeria is still the biggest market in terms of GDP. But if you're looking at the financial market, obviously South Africa is way more advanced than Nigeria in terms of market cap and number of listed companies. And so for companies trying to raise capital in each jurisdiction, will definitely have the same challenges of limited number of investors. But so this linkage program gives that advantage for investors across the various exchanges to be able to link and take advantage of the liquidity that linkage will provide. So what has happened is 7 exchanges will commence this pilot phase on the 18th of November. And what has happened is their exchanges are linked, so there's a technological platform linking the exchanges that will allow investors in those countries to be able to trade into other countries in a seamless manner. The project itself has been ongoing and is being funded by African Development Bank. But the beauty of it is, apart from the listing and trading opportunities it provides, but it also provides market data. And so there's also the market data integration across markets. So people in Nigeria can become a lot more familiar with opportunities, say in Nairobi or Nairobi Stock Exchange, or what is happening in Casablanca Stock Exchange. And so there are about 7 of them, PRVM that houses most of the Francophone exchanges. You have Casablanca, you have Egypt, you have Nigeria, Nairobi Stock Exchange, and you also have Ghana and Mauritius joining, but they will not be joining the pilot phase. So ultimately, in all these different markets, you have brokers, trading license holders that will be able to route orders from one market to the other market. So the brokers already have gone through the testing phase, and they are able to trade in a seamless manner on behalf of their clients in other markets. So Casablanca, like I said, the Egyptian Stock Exchange, you can buy and sell shares in Nigeria from those countries. And Nigerian investors can also take advantage of different sectors that are growing in other parts of the country, or in other parts of the nation or continent, to be able to take advantage and increase the value, primarily the value and return for their investment. So the linkage project, in a nutshell, it will help improve liquidity across markets in Africa. It will also help boost trade. And there's also the settlement element that perhaps will certainly be more useful in settlement of the trade across currencies. That reduces the dependency on the dollarization of the different exchanges as they trade across markets. So that's really where we are. It commences on the 18th of November, and it will be launched officially on the 7th of December. So we're really excited about the opportunities that are available and this initiative presents.
Thank you so much, Mr. Jude. It seems like the NGX and the participating brokers are quite ready. So should we expect to see the first live trade as soon as the initiative is launched in December?
Yes, certainly you will. If you recall, there was a WACME transaction that occurred, the West African capital market integration that has taken place already, and Nigeria and Ghana were able to execute that trade that was done in 2015. So we certainly expect from the Nigerian brokers, these are brokers already who are familiar in trading across the various exchanges. So we'll expect trades to occur. But the opportunities that it presents to the retail investors is really around the ability to tap into other markets. So if there's a downturn in your market, you can still be invested in equities across other geographies and gain the benefits of being in equity. We all know ultimately equities outperform the fixed income market in the long run. So we're seeing a lot of volatility now in our market, just given where the NPR is, rates are rising. But there are certain opportunities in other markets that retail investors can really benefit from. And so this project, linkage project, allows that ability to trade into those other markets in a seamless manner. So yes, we will certainly see some trades when we launch the project.
Okay, thank you, Mr. Jude. So, moving on to the next question, it's the importance of transparency and safety in any capital market cannot be overemphasized. So even though the Nigerian market is in a very good place when it comes to that, are there any new initiatives that are being planned by the NGX in its capacity as a self-regulatory organization to strengthen this safety and transparency in this market?
Yes, a lot is going on in that space, to be honest. The Nigerian Exchange is really committed to the highest level of transparency, corporate governance. You recall we launched the premium board a while back, which is predicated already on companies that have the best level of corporate governance. And we are also very big in terms of sustainability, encouraging corporates to be more active when it comes to the ESG work that they're doing, because clearly it shows that capital or investors will certainly be investing more in companies that have better governance, companies that care more about the environment and all the social impacts of where they conduct their businesses. So the exchange remains very active in that space, just to provide best-in-class leadership around the sustainability report that we have produced, and also encouraging other corporates. But beyond that, I mean, around transparency, you recall the exchange also had that event a while back with the Nigerian Bar Association, as well as the business law section, as well as Institute of Directors, the Triangle Pact that just allows and heightens the level of governance, transparency, and the ability to ensure that corporates continue to operate under the highest level, giving the environment as well as the investor protection into effect. But let me just highlight also the work that the regulation is doing that benefits the market in terms of the gap analysis that we conducted, which today is revisiting the listing rules to encourage more listings and more participation of companies in our market. So the exchange continues to play a very active role around this. We have the insider dealing reports now, which allows investors to track what is going on when an insider does a trade. So that report comes out for the market to see. So the level of transparency that we have now, it's a lot more heightened than what it was before. We do have a whole department in the regulation business that is committed to market surveillance and just with the right tools, ensuring that even intent before the transactions are done from the pattern, they're able to pick that up. And enforcement, working with the not just the regulators, but also the EFCC and the rest to ensure that corporates are completely removed from the market. So a lot of work is going on in that space, and we continue to strive to build a world-class institution that is very competitive, not just in Nigeria or Africa, but globally as well.
Thank you so much. The reports that you've alluded to, am I right to say that they are available on the NGX website for investors to access?
Yes, we do have a lot of touch points that you can have access. The website is very functional, it's user-friendly, and we have different channels that you can also access our information very easily.
Okay, thank you so much, Mr. Jude. So going to the next point of our discussion, the FX liquidity challenge that is currently facing the Nigerian market is very topical right now. It's very hard to have a conversation about investment and the capital market in Nigeria without touching on this. And it has affected the capital market in terms of investment activities of especially the foreign portfolio investors. So is there any market advocacy that the NGX is undertaking aimed at resolving this problem and this issue? And is there something that you can please share, provide insight to us, to the participants on this conference?
All right, that remains a big elephant in the room. To be honest with you, a lot of talk has gone in that respect. So we're not going to try and reiterate all that has been done. From the NGX perspective, we remain at the forefront of advocacy in terms of the attraction of foreign portfolio investment, not just for the portfolio investors, but also the foreign direct investment in Nigeria as part of what we do, helping issuers to raise capital. And so if you think about it, clearly this is something that started not today, it started 2014 when the inflows just started experiencing that huge drop. And in 2015, 2016, we did see the market go through that low level. But cyclically, every 4 years, you see the international is moving. But now it's more pronounced. So today, we have a market of 16% international, as opposed to 50% international in the past. And so the way we're looking at it, it presents us an opportunity to actually deepen our own local market, the investor base of our market. Liquidity, they say, begets liquidity. Apart from the FX challenge, if we're able to get the PFAs, they have about $30 billion, they have 6% allocation to equities. That doesn't make a lot of sense given the young population that we have. So those are the sort of advocacy and conversation that we believe will help improve domestic participation in the market, and ultimately that will lead to addressing FX-related issues, which we all know is a case of opening up the market. There's really no solution to it. The market needs to be opened up in a controlled manner to be able to drive the sort of liquidity. That way, the speculators are taken out of the market, and then the users of liquidity can find the FX that they need for what they want to do. But the play here is to increase retail participation. We have the X Academy dedicated to capacity building, investor education, to encourage more investment in the local market. We're transitioning into digital exchange, and so we have working on products around tokenization that will help improve the participation of Gen Zs as they begin to look at opportunities that the exchange products will provide. Traditionally, we have the equities, we have the fixed income, we also have the exchange-traded ETFs. And some of these ETFs are tracking currencies or alternative investment products. So these are the ways that exchange is looking to address this problem, because it's not a problem that the exchange can resolve independently. It has to be on the advocacy side. Obviously, the main custodian of FX liquidity remains the central bank. And I believe that the governor has articulated clearly what their plans are. With Dangote coming on stream, there should be improved liquidity. There's also the fertilizer business that will also help improve earnings on the FX side. So that's the way we're looking at it. Thank you.
Okay, thank you so much, sir. At this point, I think I would open up to the participating audience for any questions. Please indicate, and if you prefer, provide your questions in the chat box. I've got one from Olu Shineye for BNP. He asks that you please elaborate what the NGX is doing on the tokenization that you alluded to earlier. If you could provide further insight on that particular project. Thanks.
All right, thanks. So if you think about the new framework that the SEC, the FX regulator, has made available in terms of digital assets. And so the exchange is now in the process, obviously, of getting a digital license that will allow the exchange to participate fully in that whole universe. Tokenization of assets here, I must emphasize, is not around crypto. The market is not anywhere involved in crypto. SEC does not encourage, CBN does not encourage it. And exchange will ultimately create products that have been approved by the regulator. We do have plans to use technology to drive inclusion in our markets. And the tokenization of assets today, you're talking about real estate, for instance, land in Lagos. It's hotcake, but you need a lot of capital to be able to participate. So with the tokenization of assets, you can't really participate as a retail investor by having a fragment of the assets that you can afford because of the size. We do have art exchange that will allow you to tokenize arts. So you can also tokenize the real products, the vanilla products that exchange has. But the idea here is really around your ability to onboard in a seamless manner and your ability to own a fraction of a whole of any assets given your income profile. That will be able to complete as soon as the digitalization framework and process approval from SEC is received. It's like you're muted. Damilola, I can't hear you.
Yeah, apologies for that. Thank you so much for a very insightful session. I'm just checking to see if we have any other questions for the NGX in the chat box before we close. I think we are good. We're in a good place to end. So thank you so much for your time and a very insightful session. And I'll hand over at this point to Babatunde Majiagbe. Thank you.
Thank you for having us. It's always a pleasure to be here.
Thank you, Mr. Chiemeka, again for taking time to join us. We did hear that there was a clash, and you had to excuse yourself from another engagement to be here. We are most grateful for this gesture, and we also take it as a that if we call you again, you'll certainly be here to give us your thoughts around what's happening post 2022 at the NGX. Thank you. Next up is, and in the conversation earlier, we had mentioned that we're going to delve and spend some time looking at financial market infrastructures, i.e. the engines behind what we see on the trading side. And today we have in our midst Mr. Haruna Jallow Waziri, who is the Chief Executive Officer of the Central Securities Clearing System, the CSCS. And he is going to be touching on the CSCS's role in future market development. As you're aware, Mr. Haruna has also been in this market, and his passion for technology is something that could be contagious in driving quite a number of initiatives around the CSD, around cybersecurity, and is famous for hosting a flagship cybersecurity conference every year. And he's done that consistently for several years. Prior to joining the CSCS, he was with the exchange, and this just talks to his massive years of experience coming from the exchange all the way to the depository. And so we're happy to have him here again, and he'll be talking about his views around future. And I'm sure you certainly will hear a lot about APIs, some jargon. So please bring out your books, your dictionaries, tech dictionaries, if you have any, and be ready to be schooled around this. So Mr. Waziri, thank you, and good to have you.
Babatunde, thank you very much. That the word massive experience is very flattering. The issue around jargon, acronyms is very flattering. Maybe half the time of what I'm saying, maybe I'm just reading it, I don't know. But thank you very much.
All right, thank you so much. And joining him is Mr. Adeyemi Odubiyi from Standard Chartered Bank. Thank you.
Thank you, Mr. Babatunde, and then good day, everyone. Once again, I'd like to thank you, Mr. Jallow Waziri, for honoring our invitation. Mr. Jallow Waziri is the MD CEO of the Nigeria Central Security Clearance System. And so this section is really going to be straightforward. It's going to be a fireside section where we welcome our audience to ask questions. And you can ask your question through the chat button. And if you wish to speak directly, kindly signify by putting up your hands so that we can enable you to ask your questions. So straight to the question, Mr. Jallow, we would like to seek your view. What are your views or your take on the roles of the CSD in future market development?
Thank you again, Adeyemi. So what is very clear to me from, if I may use the word massive experience in this market, is that when rules are being made, when new products are being put in place, when new initiatives are being done in many of the global markets, the market infrastructure is right at the center of that creativity or of that, if you like, support or understanding or structuring of any of those things. Nigeria should not be different. Now, the reason why I say this is because sitting at post-trade, there is a lot of things that you are able to see, whether it is market pattern, whether it is market behavior or activity, whether it is stakeholders, beginning to do things. That data, that information typically would be available to the market infrastructure. And as such, you'd find that many product people, as they begin to develop their products, the first engagement they have is typically the market infrastructure to tell you how will it settle, when will it settle, how.
Sorry, everyone. I think Mr. Jallow's network is bad. We'll just give him a few minutes to log on back to the call. Thanks. Sorry, once again. So we're just waiting on Mr. Jalos to dial back in. And like we said earlier, if you have any questions, you may, okay, I think it's dialing back in. Yeah. Welcome back, Mr. Jalo. Can you hear us now? Hello, Mr. Jalo.
Okay, the host has unmuted me.
Okay, then. All right.
All right, because I was muted alone. Apologies. These are one of the infrastructure challenges which we are trying to fix. There was a power cut somewhere. I'm actually not in my office. I'm somewhere else, and this has happened. My sincere apologies. I hope it doesn't happen again. So like I was saying, whether it's product, whether it is laws, the market infrastructure itself could go to regulators and say, I'm seeing this pattern, there's a risk here, how do we plug it? And it's no different in Nigeria, and I believe that we will continue as a CSD, as a premier CSD, working with either the custodians, stockbrokers, that means participants, as well as registrars across the stakeholder community to ensure that we continue to participate to aid, whether it is growth in the market, expansion, whatever it is. I believe that market infrastructure should be involved, and we are involved as much as possible. Thank you.
Yeah, thank you. Thank you so much. So our next question is with respect to with the reduction in settlement cycle. We understand there's an ongoing project to reduce the equity settlement cycle from a T+3 settlement cycle currently that it is to T+2 and possibly later in the future T+1. And we have three questions in this regard. The first question is to say, do you think the Nigerian market is ready for the settlement cycle reduction? And also, what are the key events do you think needs to happen or needs to be in place before we can effectively implement the reduction? And then what are the pros and cons of this settlement cycle reduction? Thanks.
I don't know. I knew I will not get away from the custodians asking this particular question, especially because bilaterally many have engaged me on it, and I can see Tunde is smiling because he knows this is it. But before I answer your question, let me just use one analogy that I always use when I talk about settlement cycle in Nigeria or Nigerian market structure. I have a 21-year-old son who 2 or 3 years ago, I began to ask him, what do you want to do? Why are you participating in our market? Because that's the salaries I earn to pay your school fees. And I think, why don't you look at what's going on? Because he says he wanted to be an investment banker. And the conversation I have with them, that generation, younger ones, is that, Dad, why would I buy an instrument and wait 3 days to get it? Or why will I sell an instrument and not be in cash till the 3rd day? What happens in between? He says that if I order something from Amazon, all right, in the morning, I get it delivered before evening. These are physical goods. Not to talk about electronic way of doing business. He says, if I look at the new digital assets, whether the ones that are available or not, or even mention things like cryptocurrencies and how they've been tokenized and how that market works in some form or shape. He says, I can't wait. And this new generation is a generation of instant gratification and instant results. They don't want to wait a few days to get feedback of what they're doing. When they write exams, they quickly get their results. When they do things, you see. So I now condition it to, okay, yes, this market is not just retail, but we keep talking about we need to grow our retail market. And Jude Chiamaka just mentioned the average age at the CSCS in terms of participants in the market at 54. I think it's about 53.5 or thereabout. So having looked at it, having seen where the trajectory of growth is within our markets, and we need to go ahead, I'm in full support of reducing the transaction cycle from what it is to a much narrower window for settlement. Now, for that to happen, there are a couple of things that need to be done. Number one is to ensure that all of the stakeholders are involved in the planning and in the structuring of how this reduction of a settlement cycle should occur. So, for example, let me use this community as custodians, which to me are probably going to be impacted significantly because of the way, especially in Nigeria, the way we do business. So you have issues like CI's capital importation certificate. There's the issue of funding. When does it come? There's the issue of the way international participants, do trade in this market, considering what they understand as their own risk factors in this market. So all of these things are, what has to be considered. And then when we do consider them, then we'll go back and say, let's eliminate this particular issue. Why are they funding? Can they fund earlier? Can we have a more, what I call effective way of doing it? Should the central bank be involved? Are the payment systems, switches, are they going to be involved? Should we even talk to SWIFT? I mean, a lot of those things, but more importantly also for me, is not just those external issues. There's also the internal issues. Many of the, if you like, banks internationally, custodians internationally, have legacy issues and ways in which they do things. Now, because they are giants, to turn things around takes quite a bit of time in the way they do things. We might be light, nimble, and be able to do it, but we have to also have them on the table in terms of what we do. There's also the brokerage community. There's also the registrars who also have to understand what it is. But more importantly, the exchange itself. Rules have to be changed, the SEC as well. So for me, it's not a one-day project. If I remember how in the US market they moved, I think it was more of a 14 to 16 months project to move from T+3 to T+2. Certainly, we're not going to rush it in Nigeria. We have a small project group within us who are consulting and trying to bring some framework that we all can sit down and take a look at it from a holistic perspective and bring out the issues and say, how do you solve them to make sure we move our market to T+2 and probably subsequently to T+1, depending on whether or not it does make sense for us. But again, in doing that, we have to be sensitive about income. So there's no point building a structure that will erode income in the market. Certainly, that must be a consideration for participants across channels and all of that, and even including us. Certainly, again, all of the market participants or stakeholders will be involved in terms of how we want to go. So that means I've also kind of like answered your second question in terms of what events should occur, which I have mentioned in some form or shape. Now, pros and cons. I started with that in the context of things are changing, times have changed, other markets are doing it. And, we're a small market compared to others. Our systems are brand new. They are very dynamic in nature. If you look at XGen that they have in the exchange, if you look at our own TCS banks that we have at the depository, and I'm sure, we have local, trade order management systems that are very nimble and can change quickly, built on a fresh, systems in terms of style of coding or what have you. I think it's something we can do. But importantly, everyone has to be involved in the framework ultimately, or in the structure that we're going to end. And particularly, custodians are also very important in that. So certainly, we'll do that.
Thank you. Thank you once again, Mr. Jallow. The next question is on the operational framework. We've had discussion in the past on the need to have an operational framework for asset recovery in case market operator like ourselves, the custodian goes or becomes insolvent. What we would just like to ask for the status of this. That is one of the things the investors community are looking at implementing for Nigeria.
So this is a very important issue. Yes, we've not had any situation, hopefully like that, but that does not mean we should not plan for it. We had kind of like done a draft, which we think we would use, subject to, I think, the approval of the SEC, which we've shared with them, as well as the association in what we think the procedure for asset movement. And this is in line with best practice from what we've seen with our peers subsequent to, looking at as high school CPMI, CPMI high school principles around all of these things. So the first thing is when people are undergoing that bankruptcy proceedings, the regulator should endorse, some kind of administrative team to carry out special examination, for example, to ensure integrity of the assets as a procedure. Now, because you have to look at what kind of account holding pattern does that custodian have? Is it ultimate beneficiary owner, or is it omnibus account holdings, which you have both in this case within the context of our market? Then there's also a declaration by the participant, which could constrain the participant from receiving assets unless the assets have been settled previously, so you can't take any new one. Again, I talked about a special examiner that is important to be done, to be granted all the enterprise records and bank accounts. And then, in the event that there is a filing of bankruptcy, access to records and clients that will be an important factor, as you know. And then, of course, no access to required operational records, if you like, for that institution, and access available to operational records must be there. So, there also is a modality for transfer. So how do you transfer it from that to a designated or appointed other custodians with ultimate beneficial owner or otherwise? Again, there's a standard process that requires things like no objection letter from CSS to continue to do all of this. Again, how do you transfer assets from the bankrupted asset for accounts in omnibus? There's a process for that. Then, of course, how do you on a periodic basis ensure that the records are available and up to date? So we've done that draft. We have, I think, shared it with the asset custodians. And again, it's in principles, in line with the principles of CPMI high school. And by the time we get that into the SEC and the approval, I think it will now become something that's out there. But certainly your inputs are very important. And also, we've looked at the CBN's recovery process in terms of when such things happen. And we've included some of the steps to be taken based on that recovery procedure, also added into the framework. But, it's available at any point in time. We can share it with anyone to give us input as we begin to fertilize it.
Thank you. Yeah, thank you. Thank you once again. I understand it's a live question. Biodun, do you want to ask a question now before I move on to the next question? Okay, I'm not sure if he's ready. So my next question is on, so we understand the CSS is working on a lot of API solutions to improve market efficiency, and which give back to the likes of shares, detachment of shares, which before now it was done manually, and then there's an API solution for dealing this now, which has increased the turnaround time in terms of moving shares from the main account to the trading account and so forth. What are the other CSA initiatives that you're working on to develop our market? Are you looking at how you can also leverage blockchain for corporate action events as well? Thanks.
Okay. So for blockchain, as you know, I think we've done for announcements in terms of a POC with us, Standard Bank, Stanbic here in Nigeria, and a registrar through us. That one is done and dusted. Now, what do we do with it? So we went to the SEC committee on technology and said, guys, we've done this. How do we adopt this as a measure within the market? Because with any blockchain, as you know, you need multiple nodes that have to affirm. Smart contracts have to be defined in such a way that everybody, is on that chain, whether private or public. But in this case, you know, the definition of what private and public can be varying from place to place. So that's that. Now, is the market ready? I think some are not, but to drive it would require a whole market adoption from A to B to C to whatever it is that's possible. So that's that. Should we go and dust it and begin to look at it? I think maybe at the next meeting for Capital Market Committee meeting, we might probably just bring it as an AOB to say why we need, how can we move forward, because you know that technology today exists. Now, in terms of initiatives, as you know, we continuously are doing new things to give the experience for participants, investors, whether they're international or local, and issuers across any of the exchanges that we support, or custodians who permanently are working with us to improve the efficiencies we have on ground, as well as that experience for their customers. But today, what we've done is we've built, I think, about 17 APIs that can be consumed to do a lot of things, including, but not restricted. I have a list of them somewhere. Account opening. So today, brokers can open accounts directly from the system under their trade order management system using two sets of APIs. There's a direct one that comes directly to us, which is separate, and then there's the one that goes through their own trade order management systems. And there are two major ones that have passed the test that will allow them to join. I think it's Zanzibar LLC and who else one? I can't remember the name now. So two of them are on, but then other brokers talk to us directly for many of the things that they can do: open an account, intermember transfer, account update, because there's a rule by the SEC that says that if you get an order mandate, the KYC must be completed before you do a trade. So we have portals and APIs where we give brokers to be able to connect to our system to be able to update them by themselves. We have Reg Connect with the registrars where we exchange information on a daily basis after trades in terms of for them to update their register. And of course, there's a pull and push type, systems that we use daily for reconciliations and all of that. There are also the connections we have with the exchanges. Today, with 2 or 3 of them are actually, so one is a hard pipe we built and based on the SDK they gave us from their providers, but then others are also using APIs to connect to us. If you look at DMO, there's some work we're doing with DMO in terms of the federal savings bonds that will allow for brokers, individuals to be able to, as there's a reconciliation issue that will be able to allow them to upload or subscribe to the federal savings bonds using DMO portal seamlessly with validations and all of that. One of the things also we're thinking is in terms of validating. So there's NIPS for the BVN, there's NMIC for the NIM, and also for our LEI, there's also the CAC to confirm RCs and all of that. So all of these things are going on simultaneously. Again, is to just increase the efficiencies in the market and the turnaround time. And also, more importantly, is that the data we capture must be seamlessly correct at all times, validating all of this so that we don't have the backlog issues that we have around KYC and inadequate data. So, top of my head, these are the few things that we're doing, and a lot more. Like I said, 70 APIs are live now, and there's a lot more we're building before the end of the year to support the market as it is, being a market infrastructure.
Okay, thanks. So I have a question from one of our FPIs, and it's in respect to I think the second point we touched on, which has to do with settlement cycle reduction. So the question is, we fully understand the rationale for having a reduced settlement cycle, but there are so many potential obstacles that must be addressed first, e.g. end-to-end connectivity, timelines difference, best-in-class settlement model, etc. And considering the fact that the CSCS is currently looking at a 5-year cycle to find a solution to the removal of the dual account structure, can we assume that this will impact our timelines for the settlement cycle reduction as well?
So Olu and I have had this discussion over and over again around dual account structure. And to be honest, I always said that CSCS is ready, is the other side of the market. Now, which one is burden and more important from a global market perspective rather than from a community perspective? If you ask me, the dual structure is community-based, while the reduction of settlement cycle is, sorry, the dual structure is one community-based. The settlement cycle is a bigger global community as it is. We've never been averse to a dual structure. We looked at it. We looked at other for like stakeholders involved in this dual structure that has made it take some time. But certainly it's not off our burner. It's something we're looking to do. In terms of the T plus, the reduction in terms of transaction cycle, like I said, the framework is out. We've been consulting with everybody. If we adopt the model that DPCC did or all of that, they did in 16 months, that's thinking about, they have legacy issues like you have in BNP, you build some structures to change it, to update it. I know it's a monster effort, but certainly it shouldn't be a difficult thing to do, especially the reduction of transaction cycle. I think that one is the most straightforward one than a dual account. And what I always say is, engage us more, bring the what, if you like, the discussions to our table. We're doing so many things, sometimes we can't do all at the same time. But certainly, Olivia and I have had that discussion. Let's continue it and see whether we can fast track it. Again.
Yeah, thank you. Thank you so much. So Abiodun, are you ready for your live question now? Hello, Abiodun?
I think he's on mute.
Yeah, okay. Maybe I'll just ask my next question and wait for him to be ready.
Hello, sorry, Yemi, can you hear me?
Okay, I can hear you now. Carry on, please.
Okay, sorry, apologies. I think I needed someone to unmute me. Thanks so much, Jalo. Always exciting listening to you. I will keep my question very short, but I think it's a question that we've asked repeatedly. We are having multiplicity of infrastructure in our market, including CSDs. And I know that Coco had tried to explain on the CCP side. But my question to you on the CSD and also on the exchange side is, are we ready for interoperability now? Can I trade on FMGQ and settle it on CSCS?
So in terms of readiness, we are. And we had meetings with the CSD at FMDQ, and I like the answer people gave. I don't know that I was Titi that was speaking to him in terms of why do you have separate infrastructures? Entrepreneurship brought it into the way it was. But in our own case, we know we're the premier CSD. Again, maybe entrepreneurship also drove FMDQ to do that. The truth is we're ready for interoperability. We had the SEC wrote to us. We also wrote to FMDQ CSD, and I think they were working through some technology change or improvement to be able to do it. We had met with them once. We had sent them our own side of what it is that our readiness is to it and what we can or cannot do. But we are yet to connect as it is. And I think there was a timeline given by the SEC. I think we might be able to achieve that very quickly. I can't remember the exact timeline, but our teams have been working to ensure that will be done. So for me, it's not a problem. But does market currently provide you alternatives? It does, pending when we do that interoperability. And certainly, once they're ready to come, certainly.
Thank you. Okay, thanks. So the next question. So we know you are CSCS is a member of the international community, International Securities Service Association, and we also know that you are a member of the operating committee. We just want to know what is the relevance of this committee for us as a Nigerian and also to the Africa capital markets development?
Thank you. ISA primarily is the International Security Services Association, which is based in Switzerland, and primary objectives are to assist our communities in the post-trade to be able to make it better, connect everyone, and ensure that it's growth within that market for the post-trade as a whole. And they have significant work done in working groups and papers published from technology in terms of blockchain, how it be done, to settlement, to single, single discovery, I think they call it, in terms of what CSDs are doing globally from that aspect, and many more things. So standards have been suggested, and from a community perspective, they do quite a bit of work for the market. Now, they've only had Monica, who was then the CEO of Street, representing the World Forum of CSDs, sitting on the opportunity committee prior to now for I think 4 or 5 years, prior to when I joined. Because of the work we've done representing our community, particularly AMIDA, which is Africa Middle East Depository Association, and also our relationship with this association, has made them upgrade us to executive board membership. And that's because we drove the domestic CSD working group, bringing together the issues that we have locally in many of those smaller markets and bringing to the attention of the community, of the association, and which led to them making recommendations across board, understanding what the issues we have, especially before COVID and during COVID particularly, lessons learned, points I've done. In fact, at the next symposium, we are going to present that particular work outside the work that has been done by that working group. Again, the idea is, when they sit down and decide to write working papers or set or recommend standards globally, we should have a voice. Our market is slightly different. Look at what Olu said. We have divergent, it's taken us so much to do a single account structure and all of that, and dual account structure. And we're talking about T+2. Many of them have moved on since beyond that, but they also have to give us learning points. We have to tell them the challenges we have, because what we try to attain is that if an investor goes to Poland or goes to the UK or goes to the US and comes to Nigeria or goes to Egypt or South Africa, he should not have to worry about the processes or the standards that is used, so commonality among others when it comes to us. So that becomes very important. And then he doesn't have to do more than normal. And that brings about what Jules was talking about, order flow and liquidity that is necessary in our markets across that particular jurisdiction that I mentioned, except for South Africa, which $1 trillion in market capitalization is totally different from what we have right now. So yes, we are very happy and proud that we're working with or inside ISA, again, to help facilitate, to make our markets better, from standards to processes and all of that. And it's been good work, which is why we've been elevated from operating committee to the executive board as it is.
Oh, that is good. That is good news. And it's good for Nigeria as well. I have, and congrats on that, Mr. Jallow. I have two questions from our audience. It's like 2-in-1 question. So he has, the FA has asked, what is the CSS doing towards achieving through DVP? And then the second question is, any update on the removal of the dual account structure?
So I think I've answered the issue of dual account structure. We certainly are working on it. We currently have DVP. So I don't know when you say true DVP. Today we do have DVP, and again, because the settlement cycles have changed, we've gone to central bank and NIBS, we've agreed certain ways, and they've narrowed the window for us in terms of how we do DVP. So today our systems are seamlessly in tune with that, especially when it comes to payment, because that's what people are afraid of. Does the share settle before cash or cash settles before cash? Right now, we do it almost simultaneously.
Okay, thanks. And yeah, so we're about rounding up. Please, audience, if you have any question, please send in your question. So the last question for me is, what is your message to the investors or the capital market operators for the new year ahead?
Okay, I think we have to up our game in terms of knowledge and processes for the things to happen. We have to invest significantly. I'm talking about market participants, all of us, significantly in technology. Is moving very fast. It can be expensive, but maybe we should build capacities in-house for solution-based building. Again, I keep saying that, people are talking about infrastructure. For me, I always say this is the infrastructure. If you're not in here, you'll be dead very soon. So whatever we do, we have to understand what is the infrastructure, how can we plug on it. At CSCS, we're trying to become a platform so that anybody can come and plug and play and do whatever they have to do. The issue is we have to try and find a way to reduce the cost of doing business for investors, the cost of doing business by issuers. And the cost might not just be cash, implicit or explicit. It can be also time, which can be very costly. And so we have to provide that platform for them to be able to have multiplicity of opportunities to do what they want to do at the least possible cost, as the fastest, efficient way, and the rest can become easier. And again, we need to build back trust in our market. We need to also, begin to sell our market and say, these are the, progress we're making, rather than talk about the mistakes. The mistakes will come, but it's how we fix them. I mean, I always use Amazon as an example. Amazon can deliver a package to another place. It's how they resolve it that makes you happy and come back and do it again. People will make mistakes, no doubt. Things will fail. But how do you fix it? How quickly do you do it? How do you make it such that, okay, we can fail, but this is how we fix it and you're happy about it? So for me, generally, that's what I will say. And I'm looking forward to a new year with new things and hopefully get our market back to $100 million a day.
Okay, thank you, Mr. Jallow. It's always nice to catch up with you, and that was a wonderful insight from your side. Thank you so much. I pass on the baton to you today. So please.
Thank you for having me. I'm always delighted to be here. Somehow I get the idea that all the custodians are always waiting for me to ask questions, but it's okay. Thank you.
Thank you very much, Mr. Haruna Jallow Waziri. Useful session, I must say. And again, I think when Yemi was asking, what's your message for the new year? He sounded like he had made you a politician who was expected to give a view as to what we look forward to. But again, I think we expect positives from the CSCS going into the year. Thank you again once more. Many thanks, and we do appreciate your time with us today. So, ladies and gentlemen, just quickly before we go to the final presentation of today's conference, we know it's been time judiciously spent, but it's in our interest to always try to share with you the update from the poll. So I would share my screen and just show you quickly what that was. So you voted and your votes was counted. And here we go with the updates. So the first question was around when, what sentiments do we think, and when do we think there would be lots of liquidity? And I just think a few people, we had well over 150 people on the call, but just a few people participated. And from what we had here, 15 says 12 months, 5, 6 months, and then 3 months. So we can see the mix from extreme to conservative. The next question, however, was what are the topical issues that you think when you're investing in Nigeria or when you're trying to hold assets? So the conversation was around of these 4 items, what are the things that will give you more or less sleepless nights? Will it be FX? Will it be settlement cycle? ISINs, or will it be corporate actions? And we have 13 who says FX. We have 2 settlement cycle, and then 1 corporate action. Interestingly, nobody said ISINs. I think we've done well as a market, and maybe this is an applause to all financial market infrastructure, the DMO, the central bank, the CSCS, the FMDQ for championing the use of ISINs in Nigeria and ensuring that all instruments, whether in the fixed income side or the equity sides, are well numbered from an identification perspective. So we'd like to thank all our financial market infrastructure for helping to bring us to this level. We hope when we have this kind of poll again in the next 6 months, when we have our conference, we hope that we'll see a more broader view and possibly some improvements as a whole. So thank you. I just wanted to share this with us as we go on to the final discussant for today. You'll permit me to introduce the Director General of the Debt Management Office. And I think this is quite important given where we are as a country. There's been lots of debates and conversations around what is most topical and what is important within the net debt profile of Nigeria as a country. And the question is being asked whether we have a debt issue or we have a revenue issue. So we would bring up the DG in no time, and she will share her views, and she'll be supported by Taiwo Sholola. But maybe before we bring the DG on, just to mention that all the presentations that are being made will be in the AACN website. So you could, the link is being shared so that you can reach out to that website. We hope within the next 24 hours, you have all of those presentations. We can also state that if there's any way you want to reach out to us in terms of clarifying any areas of any of the presentations that were made today, you're happy to reach us. Our information is provided in the website and the Secretariat as well, so as to get that clarification. So it gives me pleasure today to welcome to the virtual lectern the Director General of the Debt Management Office, in no person but Ms. Patience Oniha. As you're all aware, Ms. Patience Oniha has successfully managed the Debt Management Office. I haven't joined it in 2008 after an illustrious banking career for more than 22 years. She's championed a lot of initiatives within the space. In the DMO, she has made her mark using her leadership and extensive banking skills. Her initiatives and activities in the domestic market, which includes innovation and engagement with key stakeholders, resulted in the emergence of a robust fixed income securities market, as well as new products and diverse income base. As I said earlier, she will be sharing with us her view around the impact of Nigeria's debt profile on foreign direct and portfolio investment, and she will be, closely joined by our colleague Taiwo Sholola from United Bank for Africa. Good afternoon, Ma, and good to see you. And maybe for the records, she's also a banker of bankers. I've trained so many bankers. At some point, you know, I met her once and I said, my mom's told me that whenever I see you, I should pick a coin, meaning that you should give respect to who it's due. So it's good to have you here again, Mom. And thank you for joining us despite your busy schedule. Thank you.
Okay. It's not opening. Just trying to open my screen. Thank you very much for your kind comments. Tunde, I see very many distinguished persons here. So it's true that for formality, I have prepared a presentation, but it's more like speaking notes for further discussion. So good afternoon, everybody. And so let me just start. I think let me apologize. One of the things I did was just tweak the title a bit, just in case for your records. Your title had debt profile, so I changed it to impact of government borrowing. Okay, so the profile speaks to the stock, but I think we're talking about borrowing. How does borrowing help foreign portfolio investments and foreign direct investments? So I apologize. I just wanted to strengthen the message I believe you were trying to pass. So the outline is pretty simple. We'll look at the introduction, then we'll talk about government borrowing in two categories, and then we'll just talk about some last points. I think I have about 20 or 30 minutes. So let me go straight to it. Okay, so you know the first one I'm going to talk about, I think our reputation precedes us, but the federal government does borrow from local and external sources, primarily to finance budget deficits. So that's usually in the public domain, and other funding requirements. So these are usually some specific projects that we, borrow for. Okay, so just to make it clear, the borrowings don't just happen. They're usually a fallout from the appropriation acts. Again, these are in the public domain. And implementing the borrowing is done through a medium-term debt management strategy. So the strategy we're running with now, the strategy defines how we borrow, what sources, what tenors, what products we want to issue, and targets as well. What do we want the debt to GDP ratio to be? What do we want short versus long to be? So all of those targets are what influence how we then do the borrowing, domestic versus external. Okay, so the subsisting MTDS in abbreviation is for the period 2020 to 2023. So we still have up to next year to review it. Let me say it was done in the period of COVID, so it is very COVID compliant. The other assumptions would have had that we'll go to the Eurobond market every year. You will notice that that was tapered a bit. Okay, so the capital raising activities of government, a nice way to say government borrowing, the impact on foreign portfolio investments, FPIs, as well as FDIs, which we are familiar with. And because they impact positively, I should say, on these, it means they have a beneficial effect on growth and development. Again, for the government, we'll talk about that a bit in details. Attracting FDIs and FDIs has always been a goal of successive governments. And why do we want to do that? Why is that an objective, a long-standing objective? It's because, as we know, for frontier economies like us or developing countries like us, the amount of capital we need is not available locally. So we need to attract capital from offshore sources to finance projects, to either to finance projects or participate in PPP activities of government, or even invest in the economy, such as, with multinational corporations. But it also helps to attract foreign exchange. We can't talk enough of that. So let me go to the next slide. Okay, so the government borrowing and how it affects FPIs just differs slightly. A major part of our activities are we issue securities in the local markets as well as the international markets. So the table there summarizes what we do. In the local market, we have quite a suite of products. So from the FGN bonds up to the green bonds, if you're with me on the slide, those are the real borrowing instruments that we use. You're familiar with each of them, so let me try and keep it short. The Sukuk and green bonds we started issuing as project-type financing from 2017. The savings bond is a retail component of our portfolio, and we also started issuing that in 2017. Promissory notes, we don't issue them in the market to raise money. They're actually just issued to settle obligations of government, meaning because we don't have liquidity to make those payments for arrears, we issue them promissory notes, which are better because they then know what the specific date of repayment is. It becomes a commitment. And then on the foreign side, we issue Eurobonds. You're all familiar with that. We tend to advertise those. Forgive me for the noise. Forgive me, I apologize. So on the foreign side, we do issue Eurobonds. We've been in the market. Our first Eurobond was issued in January 2011, and we haven't stopped issuing since then, except like the COVID year, and I believe in 2019 as well. And then we issued a diaspora bond in 2017 also, which has matured and has been paid. We also have promissory notes, foreign currency promissory notes issued for the same reason, to settle liabilities of government. So how do all the securities that we issue help to attract FPIs and FDIs? The first thing to say is that at the time of issuance, all of the securities are open to local and foreign investors. So they can invest, they can bring their foreign currency and buy the securities. So very clearly that is a FPI. But even if they don't buy at the primary market, they can also buy in the secondary market. Either way, foreign exchange comes in, and we're happy with that. But beyond that, we're happy that the investor base is growing and not entirely dependent on the domestic market. Okay, the trend that we have seen since we're talking FPIs and FDIs, for the local securities, the securities we issue in the local markets, there's a core group of investors who take up, give or take, 70 to 80% of the offer in fairly equal amounts. Those will be banks, pension funds, other funds, meaning they are not pension funds, but they manage funds, and then asset management. And I would say about 90 or 95% of that is taken really by foreign investors. But what we started since last year, when we tweaked the structure a bit, was we actually appointed a local issuing house for capacity building, but also to see if that gives opportunity for Nigerian institutions to participate. So I should say that in the last two offers we've had local investors, but give or take, that was not more than 10%. So it just means that on the foreign side for Eurobonds, all of that is coming here as FPIs. Okay, so when foreign investors, just to recap, invest in FGN securities, whether in the local or international markets, that is FPI. Some of you will remember a golden period when 5 FGN bonds were included in the JP Morgan's Emerging Markets Local Currency Bond Index. That attracted large amounts of FPIs into FGN securities. The estimate is that the amount that came in, that was in October 2011. The estimate is that over $1 billion came into our financial markets as a result of Nigeria's inclusion in the JP Morgan Index. It is a well-respected index that is used by most global investors. Okay, but what we saw then was it not only brought them into the selected FGN bonds. In fact, we had to increase the size of our benchmarks because of that singular inclusion, because we then saw that the amounts were too small. The benchmark size that we had at that time were now too small for the large amounts that were coming from foreign investors. So we increased it a bit. But we also saw that it's like saying they looked into the FGN securities and thought, okay, the other securities in the market, let's look at equities, let's look at the corporate bonds as well as state government. So we did get a lot of inquiries. So that's the role that the FGN securities issuance plays, whether in the local or in the foreign market. It brings in capital for government, but also for corporates and state governments. Unfortunately, we were taken out of the JP Morgan's index because there wasn't FX liquidity. So to be in that index, you need an active securities secondary market, as well as an active foreign exchange market. So I imagine that many of the people on this call will know what happened in 2015 and what has happened since then. So inability of investors to exit when they wanted to was really, so access was always there, entry was always there, was one reason why we're taken out. So it's just to say that there are some considerations we must look at when we want to attract FPIs and FDIs. Okay, so the other borrowing that we do, these are loans. Okay, so we raise funds for government in the form of loans. So it's not only securities we issue, we borrow from the multilateral and bilateral lenders. These are usually concessional, meaning they are at most interest rate of 3% per annum. And then the bilaterals, you know the familiar names, the World Bank, the IMF, African Development Bank, there's Islamic Development Bank, a whole host of them. So this portion of our external debt actually accounts for about 60% of the total external debt stock. Okay, so while it's true that we have been active in the Eurobonds market, we still, on the external side, a lot of our borrowings are still coming from this concessional and semi-concessional sources. Okay, the loans are usually, so they don't go to the budget to finance the pool, unlike the other borrowings that we do aside from Sukuk and green bonds. They are tied to physical projects. So you all know about the airports, whether you're in Lagos or Abuja or Enugu or Port Harcourt, you know about the airports, you know about rail, whether it be the Abuja, Kaduna, I hate to talk about it, but that's it. And the terminal in Lagos, again, for those of you in Lagos, we know about those and some roads that have been done through loans from multilateral and bilateral institutions. So what happens for you to attract capital, particularly FDIs? Really, you need to have infrastructure. We all know that's what makes cost of production for the private sector quite high, and then impacts on their, or reduces their ability to compete with other markets because they probably have to do a lot of investment in infrastructure. They have to provide their own power and sometimes maybe help us do the roads leading to their factories. So by investing in infrastructure, improving infrastructure, you're making Nigeria an attractive destination for business. And by so doing, really what you would then be able to attract is FDIs. So these are not FPIs. Just for clarity, I think most countries in our position would prefer to have more FDIs than FPIs, because FPIs, they come in and they go out, but FDIs are stable and are long-term. But I think what we also know is that the FPIs come, it's like they do a look and see, and then the FDIs follow. Once the FPIs are going, the FDIs then follow. Okay, Joe, so just some last points. Like I said, this wasn't going to be a lengthy presentation, it's just some speaking notes. Okay, so from what I've said, we can see that whether we're borrowing through securities or we're borrowing through loans, we contribute to capital inflows into Nigeria in the form of foreign currency through FPIs and FDIs. So that is extremely significant. And sometimes because we have been painted black because of our borrowing activities, we try to tell people there's some good in this borrowing, you know, apart from FPIs and FDIs that follows from those activities. Even in the local markets, they're a good product for investors to invest in. Okay, so to repeat the point, the use of proceeds when we issue securities in the local and international markets, they improve infrastructure. And I think we know that without infrastructure, really, we will not be a particularly attractive destination for foreign investments, FDIs in this case. But we also know that infrastructure has several multiplier effects apart from job creation. So those are still significant. But I won't be entirely truthful if I don't say that while the FGN's borrowings can contribute and do contribute to FPIs and FDIs, there are constraints to how much we can attract. And a very clear one is the foreign exchange policy, which I talked about, started from 2015. And I think towards the end of that year was when we were taken out of the JP Morgan index. There's also issues around the environment of doing business, which is why we had this huge government initiative on ease of doing business. Starts with registration of business, getting work permits, getting allocation of land. All of that are extremely relevant for FDIs because I think I'm told that capital doesn't have color. What it knows is profit. So that environment that makes it conducive for it to do business with very clear rules and regulations is where they would go. I think the other third thing that we need to just be aware of is that the security challenges are also need to be dealt with to make Nigeria a safe place for FDIs in particular. So FPIs will come, they can come in and go out. And for those who are not coming, they can simply buy the Eurobonds from wherever they are. But for FDIs, clearly you need to address these issues as a matter of priority. So I'll stop here and thank you once again for inviting me to speak. Thank you.
Okay, thank you, Mrs. Saniha, for that very educating and insightful presentation. Thank you again. And so I'll now open the floor to the audience. If they have any questions, can you please put it on the chat and I'll take it from there. But whilst we're waiting for that to happen, I already have some questions here for you. So I'll start with the first one.
Okay.
Okay. There are some concerns about some of the monetary policy decisions. For example, conditions around settlement of government securities bids, and the impact on market participation and yield on securities. What level of engagement is the DMO having with the CBN?
Okay. You want to take that, or you want us to take a group of questions at a time?
It's up to you. I can take another. I can mention another one, and then we'll stop there. Is that fine?
Okay. Mm-hmm.
Okay. So my next question also is: what is the DMO's position on the FCY promissory notes issued to creditors by the government, and will these instruments be redeemed in FCY?
Sorry, please take that again, Taiwo.
Okay, so I will do. So I take it again. So what is the DMO's position on the FCY foreign currency promissory notes issued to creditors by the government? And when will these instruments be redeemed in foreign currency?
Okay, so let me take those. Let me say with the first one, which has to do with policy measures by the central bank. So we do recognize that we're on the fiscal side and CBN is monetary. So while the targets should be similar, sometimes they're different. So when the central bank introduces some policies, they're usually around overall, they call it stability. So that could be interest rate, that could be exchange rate, that could be inflation. We engage with them very regularly. In fact, we had several meetings with them before we were taken out of the JP Morgan index. Some of the senior treasurers in the market actually came to Abuja then, and we had that meeting with the central bank. But hey, if there are, which is one of the things we probably haven't said openly for too long, but now is out in the open, is really a bit of a limitation on how much foreign exchange we have. When I say that, I don't want to be quoted as saying we don't have enough, but I think it's in the public space that there's crude oil theft, so there isn't much. What is now coming as exchange inflows to CBN is less than what it was when we were producing 1.8 million barrels or all of that. So it's just that, and I think that is a collective responsibility. On issues, I know there were some recent decisions also taken by the central bank. We engage with them at very senior levels. Sometimes where they can shift a bit, they do. At other times, they tell us, hey, this is the reason for doing what we're doing. So where they refuse, we let it go. Like I said, they're the monetary authority, and we advise our principals. And hopefully, like I always say, the fiscal is actually represented in the Monetary Policy Committee of the Central Bank. Okay, the Permanent Secretary of Finance is there, so is the Accountant General. So hopefully we should get a balance. But do we engage with the CBN? Yes, but they always tell us, look, this is what we are tracking. So we have to react to it. On the foreign exchange side, for instance, is a case of if all the investors have to exit at the same time, or most of them exit, the impact on reserves will be high, okay, and they still have to meet the demand of the real sector, the manufacturers and the likes. So I think they put a sort of batching in place and then they make those payments. On issues like interest rates, which we've seen them hike, if you ask me, I expected a rate increase before they actually did it. If you just look at what was happening in the UK and in the US in particular, and reading the lines in between. So they finally done it. I wish to God that they stop there for this year, not increase interest rates again. So going to the foreign currency promissory notes. The foreign currency notes have, so we have the Naira and foreign currency. The foreign currency notes have, again, we spread the maturities over time as part of our liability management strategy. I think the reason you're asking that question is because there are two categories. Okay, so the first category, federal government debts, the debts of ministries, departments, and agencies, okay, issued to local contractors, largely. When I say local contractors, let me not name the names, but the big names that would come to mind if you were asked to name the big ones here. Okay, so there are no issues with those foreign currency notes. There's the other set. In fact, we have redeemed one already, one of those notes, the foreign currency notes. Then there's that other category, which some of you may have picked up in the news, the ones the FGN issued to about 6 persons to settle judgment debts of the state governments. Okay, so I think that's the reason you are asking. But let me quickly say that deliberations are going on that one, but about $41 million of that matured on October 15th and we repaid it. So there's a precedent. You know what I'm saying? As far as the DMO is concerned, there's some discipline. If you issued it, a sovereign, the holder doesn't know what is underneath, what the issues are. So that one has been redeemed. But like I said, there was a court judgment, I think early October or end of September. So let's see how the rest goes. But there are two categories, okay?
All right, thank you for that. Okay, so I have a question from the audience, Abiodun Adebimpe. And the question is, what does the DGDMO think may be the potential impact of higher Naira denominations redesign on interest rates, or interest rate yields in the market?
Okay, so I think the only way I will answer it is just maybe as a technocrat, not in practical terms. I think one of the things we know is that really prices have gone up. So you go with a large wad of notes and you can only buy just very little stuff because 1,000 Naira is the largest denomination. So what could happen? If that goes into the system, as I believe it would, it may just have some impact on inflation because spending may increase. Just some impact, maybe, maybe not. And if that happens and it is significant, we know where that will hit. That's when it will hit interest rates. The government may decide, the CBN may decide to react by increasing the MPR. But purely economic theory, everything I've said, let's see what happens in real life.
Okay, and I have another question for you. I don't know if you're able to answer it, but what is the total volume of Nigerian debts to China? The total volume of Nigerian debts to China. And then the second question is, how are we servicing this debt?
Okay, no, I like the questions. At least let me speak to people who understand and go beyond the press. Okay, we've done a lot of media sessions and publications on loans from China. Let me quickly say one point which we should bear in mind. The loans from China actually finance projects, which we see. Like I said, the airports, the rails, we don't need to go too far. So to that extent, they're plus. The loans that we get from multilateral sources are largely for reform activities, policies, but this one from China, you can see it, and they're concessional anyway, just like the multilateral, at most semi-concessional. So out of our external debt of about $40 billion, China has 3.6. Only 3.6 billion out of that. So it is small. And that's why you wonder why there's so much talk about China. I think it serves two purposes. It helps you to finance infrastructure, but it also is a source for concessional loans. So it's only $3.6 billion out of the 40. So China is not our primary source for external borrowing. And if you put the 3.6 on the total debt stock of 100 billion, it means our dependence on China is less than 4%. So please keep that in mind.
Okay, just a follow-up question to that. So roughly how much is Nigeria paying per annum? On the debt, if we have like 3 point something left, roughly how much per annum?
Okay, like I said, the loans from China have a plus. And let me quickly say, the loans from China go through the same screening that is done for all external debts. So in Nigeria, the legal provisions for external borrowing are actually steeper than the one for local. With the external, you still go back to the National Assembly and get a resolution. Okay, so the loans from China, all-in cost is about 3%. Interest rate is 2.5%. The rest are small charges of commitment fee, those sort of things that you bankers will charge, just that the Chinese ones are cheaper. Let me push it back. Okay, so that's what it is. They're concessional. Concessional means 3% and long-term, so they're about 15 to 20 years. Okay, so let's not look at borrowing from China as a bad thing. If you have traveled through the international airport in Abuja, don't ask what we've done with the China loans or any of the airports in Port Harcourt, Enugu, even Kano, and Benin. Yes.
Thank you. I don't seem to have any other question from the chat box.
Okay, so I think I missed one. Please let me address that one because it also speaks to people ask us what's the repayment plan. I think somebody asked you, how do we service them?
Yes.
One of the good things about the medium-term expenditure framework process and the budgeting process, which are usually provided for in the Fiscal Responsibility Act, there are specific line items in the budget. They are not hidden. And I think that openness and disclosure is what gives room for the plenty of discourse that we hear in the public space. So in the annual budget, debt service is provided for expressly as an expenditure item. It's not a best effort basis. So there's a provision, external debt service, provision for domestic debt service, and the DMO is the one who gives those figures to the budget office. The other third line we included when we started issuing promissory notes in 2018, we included the line that if you just look at the budget, you see sinking fund. So what that sinking fund is money being put there for the redemption of promissory notes. Okay? So they are provided for expressly in the budget, and there's a seamless process for processing. We don't send files to a minister, then it goes to this place, to that place. There's a seamless processing for external debt servicing. Okay? For all debt servicing, whether domestic or external.
Okay, thank you. I have one more question for you, and it's from Olu, BNP Paribas. And the question is, it is good to see the DMO being transparent. Are you able to provide a breakdown of the 40 billion debt?
Yes.
Thank you.
Thank you very much. Thank you, Olu.
Sorry, did you get the question?
No, the breakdown of the. I think I'm seeing another
me
question. You want to read it?
Yes, please. I said it is good from Olu BNP Paribas. He said it is good to see the DMO being transparent. Are you able to provide a breakdown of the 40 billion debt? 40 billion debt.
Okay. Total debt is about, actually in dollar terms, US dollar terms, 100 billion. So 40 billion is what is external debt stock. So just go to our website every quarter. You will see a breakdown of the external debt by source. You will see a line for what that 40 billion is broken down by source. You will see World Bank, IMF, each one. You will see the amounts. You will see China, you will see this 3.6 I talked about. Eurobonds, there's a line for it. So it's broken down. Then for the domestic, you will see the amounts by instrument. FGN bonds, how much is it? Treasury bills, how much is it? So if you go to our website, you would see under publications, you will see the figures for June. By next month, the figures for September will be there. So there's full disclosure of the breakdown. Thank you.
I'm sorry, madam. I thought I had one more question, but it just seems to be coming. So I have another one from Folusho Showande. And the question is, why do we always have deficit budget here in year out, and our revenue generation is not being looked at with all I guess, scrutiny? I think it just said with all seriously. So I guess it's
I can't but agree. I wouldn't say it is a lack of effort, but certainly more needs to be done. So we have all been around. Maybe I have been around longer time. We're dependent on crude oil. Okay, so whatever happens to crude oil hits us really hard. So I give you an example of 2020, for instance, where revenues dropped by more than 50% because really we couldn't export oil. It's also that oil that is affecting the availability of foreign exchange. So I think I'm happy. So, but we've moved beyond volatility in price of oil to inability to produce enough. We've had great times now when oil prices were over 100. But we're producing 1.32 million barrels per day instead of 1.88. And what is the issue? I'm throwing it back at you. You say it's crude oil theft. Okay, so let's do something about that. Just imagine if that's all you did, fix the theft issue. When prices were over $100, that would have helped. But having said that, there are reform measures going on. So if you look at the detailed MTEP figures, you would see that non-oil revenues are actually growing, not at the exponential rate that we need, because that's what we need, at an exponential rate. It is growing and actually now contributing more than crude oil, because there are initiatives around it, whether FRS, automation, using ICT, customs, and the other third one, which is significant also, is getting SOEs, those state-owned enterprises, to remit their profits to government. So where the FGN is the investor, surely we're entitled to dividends. So more it's been a long-standing fight, but more has been coming from there. So I think I heard my minister say recently, for the first time last year, for the very first time, we're able to raise 1 trillion naira from all of those. So that would include the central bank, NCC. Can you imagine? Those are cash cows, all of those sorts of agencies remitting more to the FGN, who is the single shareholder, the sole shareholder. So all of those are going on, but I think what we need is an exponential growth. If that happens, I'll be very happy. Budget deficit zero, maybe a surplus, then I can just manage the stock of debt, not new borrowings. Thank you.
Madam, just the last question. I can't refuse this because it's the president of the association. We've been waiting so long to have you on board. So thank you. Just one more question, and I can't, but I take this one. Thank you.
Okay.
From the president of the association, Abiodun Adebimpe. So, and the question goes: with 22 trillion naira CBN's ways and means loans being converted to long-term bonds, would Nigeria still remain within the acceptable debt GDP ratio level?
Okay, thank you very much. I want to answer that question in two parts, because just to address some of the questions that I've received. So when people heard 22 trillion, they were like, okay, you want to raise 22 trillion billion in this market? The answer is no, we're not raising that money in the market. It's already an overdraft in the CBN that will just be converted. So let's just say CBN becomes the investor in the bond, not that will have an option to issue it to the market. Then answering your question directly, we absolutely have done the numbers. Our debt to GDP limit under the current medium-term debt management strategy is 40%. Okay, as of June, we're at 23%. If we add the 20 trillion and some project-type loans that we're looking at now, we may get to about 35%. Okay, so not only will we be within the 40%, but we'll still be within the 55% that the World Bank IMF says should be the limit for countries in the same peer group as Nigeria. The ECOWAS limit is 70%, but we are not looking, if you ask me, 55 or 70, because you need revenues to service the loans, okay? Not the GDP, right? Okay.
Okay. So, Madam, I would just like to say a very, very big thank you.
Thank you very much.
It was indeed an honor to have you here with us today. We know your time is very precious, and we're immensely grateful you were able to carve out time to join us today. We hope that when we call on you next time, you will be happy. So thank you.
Choose an interesting topic, I'll be glad. Thank you.
Thank you. Thank you. And I'm sure I asked you too many questions, so put you on the spot.
No, that's fine. That's fine. Thank you.
Thank you. Have a good day, man.
Thank you. Bye-bye.
Yeah, thank you very much, Madam Path. And we'll take you on that invitation, and we promise to make our topics and questions quite exciting. And just to give you a sense that, I mean, comments coming from clients and investors, I mean, has painted you in a very transparent and good light. And I think we want to commend you on that effort, and please keep the good job.
Thank you very much. I appreciate it. Thank you. Bye-bye.
So, ladies and gentlemen, we've come to the end of this year's conference, but maybe just to run us through a few of the items that we had covered from a wrap-up perspective. I think we started the day by, hearing from the SEC DG, was ably represented by Mr. Dayo Obiso. And I mean, he gave a very strong view around what the SEC has done, and he gave a balanced view around whether to regulate the market or to develop it. And the conclusion of the matter is both of them are, two sides of the same coin. We went into conversations with the CEO, not a conversation, but we hosted the CEO of the NIPC, Nigerian Investment Promotion Commission, Hajia Saratu Umar, and she did give a view, given the mandate that the NIPC has with being involved in initiatives that make Nigeria an investment destination of choice. And we do appreciate the keynote address that came from her. Thereafter, we spent some sizable time debating about the macroeconomic view around Nigeria as it relates to inflation, FX, etc., and the view that came from the chief economist for Africa at JP Morgan Securities PLC, Mr. Bola Ontario, was quite insightful, and we do appreciate that view. And I think clients and participants who have joined today would have more or less a balanced view from that standpoint. Going on, we further had a teaching masterclass around derivatives, how to prepare Nigeria for the derivatives market, and what are really the upside. And we got a very thorough view from Mr. Bola Onadelekoko, the CEO, FMDQ Group. And we do appreciate that perspective. And he talked about how ready the Nigerian market is for derivatives, how we need to take on the South African market, given that the South African market is the only thriving derivatives market that we have. And he also spoke about timelines and potential view as to when Nigeria will get ready. And he did touch about the framework, downstream, clearing, trading, etc., which we do think will be useful to everyone that has attended. Following on that conversation, we deep dived further to getting the benefits of demutualization from the divisional head of capital market from the NGX, and he did give quite a number of initiatives that they have been able to begin to harness, given the fact that now they have the ability to do no products, they have the ability to innovate, etc. And riding on that, we had a chinwag with the CEO of the CSCS, Mr. Haruna Jallow Waziri, on the role of the future of the CSD. And in that conversation, he spoke about the insolvency regime, what the laws say, and how the market is getting ready in case a key market participant goes insolvent. How do we protect clients' holdings and clients' investment? He touched base a bit about technology. He spoke about initiatives being run currently by the CSD with respect to settlement cycle, whether it's going to be reduced from T+3 to T+2 and maybe T+1. What is informing that decision? He gave a good story about his son and how we can make the market attractive for new younger investors. And as such, maybe that was part of the rationale for thinking through reduction in cycle. And last but not the least, we spent adequate time discussing just recently with the DG of the DMO, and she talked about, well, not the debt profile, but the borrowing process of the Nigerian state, how that is done. And she was ready to take on a lot of questions around what the structure is, the Chinese loans, the loans that help to develop our airports, our rail station, our train tracks, etc. And I think we have adequately dealt with that. And her presentation also was quite detailed. Just to mention to everyone on the call today that we will be sharing all the presentations made today. We'll be sharing it on the AACN website, as well as the recording for this event will also be there as well. For those who are not aware, this was also streamed live on YouTube. So it's something that you can go back to play 5 years and 10 years away from now. On behalf of myself, I was your host for today, Babatunde Majiabetimaj, and the executive members of and leadership of the AAC and the Association of Asset Custodians. I would like to thank all our participants, all our moderators, all our speakers for investing in time, energy, and thoughts around how we think this market, how we think we can move the market forward. Our aspiration and our thoughts is that all the conversations we've had today would give us, will provoke our thoughts, and not just provoke our thoughts, will be more or less backed by actions, so that we ensure that the market gets to where we desire for the market. I also wanted to mention that the president would like to give a comment before we call it a date. The president, the floor is yours.
Thanks so very much, Sunday, and to everyone for a great day we've had. I just wanted to add quickly that we host this event every year. And like I said at the beginning of the day, earlier in the morning, that this edition and last year edition were virtual, because of travel restrictions. But with traveling opening up, we are hoping that come May next year, we'll be able to gather in London physically. So maybe this is a safety date. We haven't picked a date, but it will typically be either the first or the second week in May. So we'll really be glad if, the enthusiastic participation we had today, can be repeated, when we gather again next year, come May, God willing. So we want all our audience to please watch out for Nigerian Investor Day 23, which will be holding in London, God willing. Thanks so much today.
Yeah, thank you very much, Biodun, the president of AACN. And until we see you in London, it's a goodbye. Thank you.